right, good morning, party people. We are on social media. We're live, and now I got to get the Discord up and running. I always have to restart it. It's a minute. All right, good morning, Discord people. How's it going? Hopefully you guys can hear me. If you can hear me, please put a 1 in the chat. If you can't, don't put anything in the chat because I'll know you're a liar. Other than that, oh, thank you, sir, Mr. Monolith. Appreciate it. What's up, Porter? It is Tuesday, September 30th. We're going to do some live trading this morning. We got some good volume in the market. We got the government shutdown looming. So we're going to kind of see what happens this morning. I'm not going to be too aggressive. I do have about $30 of settled cash on this account because I bought a share of BYRN yesterday. Yeah, Charlie, 915 did. It snuck up on us, man. It's it's rough. I don't like it. I don't like that because that means that 4 o'clock and 5 o'clock and 6 o'clock are going to sneak up on us. Hey, what's up? I can't see your name. MacFDex. Discord chops the names off, so I had to fix them. All right, so it is Tuesday, my dudes. We got a pretty busy week, right? We got the Fed week. It's a bunch of catalysts, nothing really major besides the deadline. So I want to see what happens. Obviously, the shutdown is kind of inevitable at this point. I think for a lot of people, government shutdowns are not as doom and gloom as people tend to perceive them as. We had a pretty major one back in 2018, 2019. The government was shut down for about, I think it was like 35 days or something like that, and it cost about $5 billion. Not a big deal, right? That's a drop in the bucket compared to what we spend on military. So, it's okay. Also, one thing that I want to point out is just because there is a government shutdown doesn't mean everything shuts down. There's still essential services. There's still an essential budget in place. It's just shutting down a further agreement. So, it just says that like national parks, for example, those guys will stop working, which is super risky if there's like forest fires and stuff. But, but like the military, law enforcement, those will still continue to work because those are still critical services that directly impact human lives. So national parks, you could make an argument for that as well, but the show will go on. It's not the end of the world. They're not going to stop collecting tax dollars, right? So we'll see how it goes. What's up, Death Gun? Sorry, I'm just trying to read the chat really fast. Can't do with that music anymore. I'll watch the rest later. What music? What's going on, Takak? Is Takak still here, or did she leave? Yeah, there you are. What music? Yeah, don't unlock the bunker and break the seal on that long-term food. We're going to be okay. Absolutely, Charlie. It's going to be fine. There's no packs of wild dogs roaming in the streets. Oh, the general's meeting. He just gave a big speech and waiting on the next guy. Yeah, that's fair. I kind of just refuse to watch that stuff at this point. It's like watching wrestling interviews, I just want the objective information. I don't care about all the persuasive stuff. I don't care about all the spin and opinions and stuff. I just want the objective stuff. Because I got to be able to make clear decisions. And politics has always kind of been like that, but it's really ramped up over the last, 15, 20 years. And it just gets in the way. I don't need to be persuaded. I'm a rational adult. I get it. Just give me the information I'm looking for. So I don't know. I'm not going to change the world by saying that and complaining about it. So I get that too. So it is 9:18. We got about 11 minutes and 19 seconds before market open. So yeah, just move the market. That's all I care about. That's all I want. So we could see here SPY is it's moving a little bit. It's still around flat for pre-market. We're going to see the bigger move, after open, obviously. And then, of course, end of day today, I'm expecting a much bigger move into close, up or down. Don't really care. There's no point in trying to predict, but we are primed for a move to the downside as far as risk reward goes, supply and demand goes. But the market has been holding up as well. It did start to sell off, and then it pulled right back up after shallow retrace. So there is no reliable way to predict this. So we're just going to kind of hang out and see what we get. Now, with that said, I wouldn't mind doing a little SPX action today if we get what I'm looking for. But it kind of depends, right? I don't want to be crazy about it. But days like today can be very, very profitable. High risk, high rewards. So I might do that. I don't really see super spectacular movements in price pre-market here. So if I look at the 2-minute on BENF, for example, it's a 63-cent stock, so I can't trade it on the small cash account. It's $50, and I have $30 in settled cash, so can't trade this one. But we can see that we've got some clear zones here. But even this one, the chart just, oh, hey, alarm clock, how you doing, buddy? It's awake. Yeah, the shutdown is tomorrow. It is it's supposed to kick in at 12:01 Wednesday morning, so after midnight. That's when it technically kicks in. So on BENF, I got a couple levels here that I just want to kind of map out just to have them ready. Nothing super spectacular here. Just want to have them ready. And let's see, we'll draw one of these. Kind of want to just extend that up to there. Yeah, I think I might. So that's going to be a transitory level. I'm going to make that a little bit less of a disturbing color. We'll have a yellow here. We'll have an orange here. And then we'll see where this one goes. I mean, I can't trade this one in this account. But we have some pretty easy levels to watch. And then this, it looks like it's pretty clustered together, and it is. But from like here to here, that's a 5.5% move. I'm okay with that. Just little scalps. But that's the kind of quality we're getting this morning. We're not really seeing a whole lot of like huge moves that are directional. We're seeing a lot of chop, and that's kind of telling me that maybe it's not the best day to be super aggressive. IBG may get volume, maybe not. It's a pretty deep retrace. CRE is a good candidate. I like it, but it doesn't have the consistent volume that I'm looking for. Ideally, this volume here would have plateaued and just gone flat. Flat across. So sustained volume above 500,000 shares per candle. This is 2-minute chart. So maybe. So let's see here. I got to make myself continually check back in the chat here. Did I hear full port SPX? No, I only have 60% of this portfolio free, so I can't do a full port unless you want me to catch a good faith violation. So we're getting there. That's a small account. I started with $45 and I'm up to 52. Death Gun, rather than going on a walk or going to the gym, I switched games to something just as infuriating. Oh no, you playing League of Legends or something? Ready to start the day with some trading. I really would encourage you to use a paper account. Charlie, how are you trading SPX with $30? There's a couple ways. We can use the SPX minis. But I'm not going to do that. Typically, for those, you would just end up going farther out on the strikes to get cheaper premiums. I'll show you. I'm just kidding. I mean, if you guys want me to trade SPX, I'm not opposed. We can definitely do that. Can't do paper accounts, Pookie, against my personal morals. Well, I hope losing money isn't like unnecessarily, isn't part of your morals, because I hate seeing that like that process, right? And that's not a dig at you. It's not a character flaw. It's just a human trait that we all kind of have. And later on, you're going to recognize it's kind of unnecessary. You're looking for short-term relief because of an emotional charge that was prompted elsewhere. And then we come to the market and we kind of use it as an emotional punching bag. The problem is it's a lot bigger. It hits a lot harder. It just spent 15 years in prison. It's out. It's looking for some touch. You're the only one around. It's you and that in a room, just you in the market. So go ahead and take that first swing if you want. I can't crack my knuckles. I was trying to crack my knuckles, but that's not loud enough for you guys to hear. So, I don't want you to hurt yourself, But I get that part of human nature means that we're going to, and that's all part of the process. I get that. So first things first, let me just kind of zoom out. I'm going to just erase all these lines here. So yeah, I mean, if you guys want me to do some SPX, I will. Again, I only have $30, so it's going to be high risk because it's pretty much just going to be a YOLO on that $30. So let's pick our shot. I want a high quality setup, right? So first things first, I can't really do much on the daily chart here as far as plotting those ranges that I like. So let's kick it down to maybe the 1 hour. Yeah, it's kind of messy. Kind of got a level here that I like. Maybe. Yeah, that's pretty good. I like that. Now, is the price going to come up there? I have no way to know that. So I can already see a bunch of smaller levels, and that's kind of what I'm looking for. So let's kick it down to the 15-minute. And I'm just looking to see, where does the price displace from with intent? Bryce said bullish. It could go either way. I mean, it's got a lot of activity, right? So let me see here. Might come down to the 10. Well, you know what? Let me check the 30-minute. I kind of skipped over the 30-minute. It looks like scribbles, I know, I'm sure. But what I'm really looking for is the same things that I've kind of been teaching my strategy on the live streams lately. So basically, I'm just looking for areas where the price consolidates a little bit. We see some chop, and then we see a displacement, right? And the problem here with SPX is that in this kind of market, the price almost always comes back and retests those levels, and it just makes the data muddy. So it's very difficult to get clean ranges on this. So let me just do my best here, and we'll see if we can plot some ideal zones. So I kind of got this guy here as well. Yeah, I kind of like that. And then, yeah, okay. So I think we're okay. Now I'm just going to color code these based on their quality. So we got a transitory zone here. We've got kind of a, it's transitory now, but I'm going to color code it yellow because it has potency. And then this one here is a higher potency. And then this one here is our good structural level. So now with that said, I do have a peak here, but it doesn't have a lot of consolidation. Like there's nothing really to say, you know, the price did this or that there. You know, I've got a zone here, which is nice, and it's a higher quality level. So I'm going to go ahead and draw that. We'll go ahead and mark it as a transitory level. And then in theory, right, if at open in 3.5 minutes, we push down into this zone, maybe we gap up. I got to look at SPY specifically, but we'll see how this opens up. But if we do, I'm going to also plot the high. If we do open up and we come down to this level, the theory holds that we should push down, and then we've got a gap and a transitory zone here, which could also just as easily plummet through to that level, which is also transitory. So we might, I'm not saying we're going to come all the way down to like 6,300 today, but there's massive potential to the downside here. If we push to the upside, we've got a peak here, right? And then it's new highs, and that's not necessarily a deal breaker. It's just something I need to be very careful of if I look to trade this one. So I'm going to have to take profits a lot tighter to the upside, I think. And since I'm going farther out in strike, the IV fall off and theta are going to fall off a lot more aggressively, specifically the IV, because the volume is going to be less. There's going to be lower concentrations of volume on the farther out strikes on those. So I'm going to have to be a little bit more cautious today, and that's okay. We'll see how it works out. So I might just lock it in at a quick 30% unless I get a strong directional move, in which case then I'll take kind of a high risk, high reward scenario here. And BYRN also, we kind of reviewed that one a little more in depth in Lifetime yesterday. I really do like that stock. There are some risk factors, obviously, but that's true with anything in the market. We got about 2 minutes and 9 seconds till market open. Does anybody have any questions before I do stuff? And, you know, I could further refine these zones and all that good stuff. I don't think I'm going to really care too much about that. I might draw like this guy right here just in case it's like a breakthrough zone. But I'm not going to care too much about that because it's not really going to matter. And I got this one here, obviously. Yeah, like right there. You know, if we come down, there should be a pretty easy target, in my opinion, just to hit that. Now, obviously, this is disclaimer time. This is super high risk, right? I've got $30 settled cash. You know, it's a okay. Whew, my StreamYard wasn't showing my screen for a minute. Sorry about that. We back? All right. So I'll just run through the disclaimer again really quick. Don't copy me. Don't ever copy me or anybody else. This is high risk, high reward. This one is going to force me, since I only have $30 cash, I have to go far out from the strike. Like the 65.50 contract, for example, that's down here, you know, so I got to be very cautious about, you know, when I enter and when I exit. So this may and likely will go very far down in a very short amount of time if I don't get a profitable outcome. So please don't over allocate. Please don't copy me. I can't legally tell you guys what to do. Yeah, Hillary Clinton got me. I had information about the shutdown. So they shut me down. All right, we got about 6 seconds before market open, and I don't have to jump into anything like right off the bat, especially with SPX. It's going to be very volatile, right? So here we go. So it looks like SPY is open, and I'm just going to kind of keep an eye on it. Looks like it's getting a little bit of contention in that bullish move. Let's see if that's going to blast out of that zone. We got this nice clean channel here mapped out all the way up to 666. Haha. So let's see if that does that. I am bearish at this point based on what I'm seeing. So let me come over here. I'm not going to jump in just yet. Maybe I will. But, you know, you guys can see I have to go pretty far out here. And I'd like to see it pull through this zone down here, or at least below this low, because I don't want it to catch a bounce, you know. So we'll just wait. That could have been the entry opportunity right there, and I'm okay missing it on a day like today. I don't want to rush in. I've got one shot, so I'm going to wait for a quality setup. And that quality setup is going to be down here. So we'll see what we get. We'll watch the paint dry, and we'll be patient and disciplined. Don't joke about that. It's too late for me. They didn't give me my $4 billion trading budget, so they shut me down. All right. So with that said, I know kind of where the price is going to be. I know roughly where I want to get in if we go to the downside. If we go up, I also have another idea on that. So it's just a matter of kind of identifying where I'd like to get in and then which contracts I can pick from. So up here, I'd like to get in probably around 66.58-ish if it wants to go to the upside. And for that, I'm just going to pull up my calls. And for that, I got to scroll up quite a bit. Now there's pretty sparse volume up here on the calls, and they're closer, right? Because the IV just destroyed those calls on that pull down. So gonna go ahead and see. I might like the 67.10. I'm just kind of looking across the line here. 67.05 is better in terms of quality, but I'm not gonna be able to get in that with $30 by the time the price goes up here. It's gonna be too high value. So I might have to get a little bit over 67, and that's if and only if it goes up. So in the bullish case, I'd be looking for a strong bullish bounce off this zone here and over the high a day, or the local high, right? That's kind of the easy attempt there. And then of course you got a secondary target up there at the previous high, the all-time high. I assume it's all-time high. And then for the bearish case, obviously we're looking for a push down through this level and then to trapdoor all the way down, at least below 6,600. So again, this is my one and done for the day. Since I'm trading SPX, I have to be very judicious about which contract I take, and more specifically about my entry, because right now, you know, if I were to enter, these are just going sideways, essentially. Like it pushed up, pulled down, specifically at market open, it pulled down, and then it's just kind of hanging out. This is indecision. So I got to wait for a direction to be chosen. And if it goes down, I don't just want to get in when it goes into this zone, because it could very easily bounce and that would destroy it. So does that make sense to everybody? There's short-term scalp opportunities, absolutely, in my opinion, but I can't trade those unless I want to do little $10 contracts, and those would probably get destroyed on a day like today. Charlie, please grab a screenshot of the order form for confirmation. Yeah, no problem. I got you. Do you want me to type it in chat? I can do that. All right, we got about 10 seconds left, and then if this candle closes here, then I'll move my entry threshold for a bullish trade up to 66.5623. And where's the naked cat? He's outside my door. I could see his little feet and his little gut like sitting over his feet. Like he's like a penguin sitting on an egg. There's a little gap under the door, and I can see his shadow. It's a hardwood floor, so I can see the little reflection. He's gross. Adorable, but gross. He's a little mountain lion that's like way out of shape. he's got to go to Bali. I do not let him trade with me. No, he's too impulsive. He's a gross little goblin, and he doesn't know how to keep his hands off the keyboard. Yep, it's quietly judging. So as I'm looking at the local price, I also see this this kind of chop range right here. Let me make that yellow. I'm not using this for any specific purpose here. I'm just highlighting that we do have a range where the price did break out violently twice, as well as a transitory level twice, right? Price entered, passed through, price entered, passed through, price entered, passed through, price entered, passed through, price entered, passed through. So 5 times the price has done transitory things at that zone. But it also shows some friction and some stickiness within the zone, which tells me that this could very easily turn into a reversal zone if we get a more substantial move into the orange box down to maybe here to challenge these lows. And then if we do potentially break out, this zone could have some significance for potential retest. How about Puddle of Mud Wi-Fi? Everything's so blurry. I hate it, Porter. I can hear it, but it's like buffering. So it's all glitchy and stuff. Keep falling. Yeah, Mr. OG, I'm kind of waiting. You know, again, there's so much more potential, in my opinion, to the downside here. You know, this is kind of a lightning strike setup kind of day, but we got to be patient. You know, if it's going to come all the way down here, it's going to come through this box, you know. So far, we're just barely touching into the box. We haven't even broken the local low yet. So I'm going to be nice and patient. We're going to see where it goes. If it breaks over 66.56.23, I'm actually going to grab a call, and I'm going to keep the trade nice and tight. Charlie, oh no, I haven't taken anything yet. There is no SPX order book because SPX does not report volume. It's not shares. They're European style cash settled options contract. So it's not you. It's not you at all. Gotta find a phone charger. Oh yeah, okay, definitely take care of that, man. We'll be here. Mr. OG, I got some stuff expiring mid-October. Market needs to fall. Yeah, let's rally for Mr. OG. You got to call up the market and be like, hey, I want to make money, guys. Knock it off. Now, the issue here is that a lot of times when you have a fear-based catalyst or a catalyst that rallies, you know, non-traders, non-investors, like a government shutdown, for example, people get very reactive, which means that the market can exploit their reactivity. So in this case, most people are expecting a move to the downside. And then there's the contrarian view, which means, oh, they're going to exploit the hell out of those shorts, those bears, so we can trade it to the upside, and we're going to get the cheaper contracts, and it's going to rally, right? And then the ones who are initially bullish saying, oh, it's baked in, blah, 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 it's going to go up anyway because the market's been rallying, it knows no bounds. They're going to have a contrarian side too that says, oh, there's a bunch of idiots that are about to buy the new all-time high. Let's short them into oblivion and cause them to lose, and we'll make a ton of money on the way down when they all turn into sellers, right? And the argument can be made on both sides, and that's the problem with the market, is that there's no right answer. It's literally just a setup between banks. There's world banks, there's other institutional types, but they're all just, as Tikak said, it's all a game. You know, our job is to not give them our money unnecessarily. You know, and they're not going to let us, like Austin said on a stream yesterday, they're not going to let us play unless we're giving them something. So what are we giving them? In most cases, it's attention. We give them attention. We give our attention in the form of currency and kidneys. Yes, Porter. Yes, we give them kidneys. Just big bags of human organs. Please, stir. Stop donating. I don't know why I said stir. That's weird. I need more monster, guys. I need more power. So here, for example, would be an anticipatory bullish entry. So there's going to be a lot of FOMO buyers that are going to want to catch the buy up. And, you know, I'm not going to say I'm not one of them, you know, but I'm disciplined enough to recognize it and to slow down and temper that impulse. And let's see how it works out for them first. If they start making money, yeah, I'll jump in. I'll take a little bit of a risk, but I'm going to make sure that I do it in a measured way and that I'm not jumping in ahead of time right into a potential rejection zone. So I want to see it go into this zone at least before I take an entry. Now the safer entry is going to be up here, but if we do get a push up out of this zone, I might get in a little early just to make a little extra scratch, but that's also because I am taking a farther out of the expiration money contract, and I'm probably going to be looking at the 65 Let's see here, 6507. Oh, sorry, 6705. God, I can't talk today. Jeez. 6705, 6710, potentially. Now, obviously, this is stupidly high risk, and these contracts are going to move, so I might even miss my fill. So if I try to get filled on the 6715, for example, it can jump from 15 cents up to 40 or 60 cents in a blink of an eye. Now, I do like that this is, okay, actually, yes, this is showing me an institutional signature, so I'm going to get in as soon as that breaks. I'm going to grab the 6705 if I can get filled. Dang it. If I can. I might have to go up another contract. Yeah, I think I'm going to have to. Dang it. All right, so it looks like I'm going for the 6710. Aha, I lied. I got you all. All right, let's see. Did I get filled? Yes. Okay. So let me put this in the chat for Charlie here. This is obviously high risk, so please, again, do not copy me. SPXW 6710 call 0 day filled at. God, I can't type that either. All right. So obviously high risk, and I need to be very, very cognizant of the neighborhood that I'm in. And this requires a pretty drastic move to the upside. So right now we're in that friction zone, and then I've got a local high here that needs to be conquered. So let me kind of make that orange. Now this should be in a pretty insignificant level. It's yesterday's high. I think it was yesterday's high. No, it was not yesterday's high. It was the pre-market or the pre-close high from yesterday. And that range itself that's establishing is, you know, it's used by some traders here. But right now, basically what I've got is a 5 candle run, which just got, well, almost 5 candle run. It's good enough for me. Just got broken into and out of almost an area of high potential violence. And that's kind of all I need to justify a trade. So the bearish entry would have been down here. We're pushing up into this friction zone here. We're ending on the kind of the termination of an impulse, and that should fuel the fire and get us a nice bullish rally, in theory. So now it's just a matter of whether or not I get outvoted. So that's how it goes in the market. So I'm going to set my sell order up immediately, and then I will let you guys know when I get out. I'll announce it, and I'll also put it in the chat for Charlie. So right now I'm up 12%. I could sell this at any time and just walk away. There's going to be a spread on it plus the fees. So I have to pay $1 or $1.50 or something every time I buy and sell an options contract with Webull. So I got to keep that in mind too. So I'd like to make more than, 10 cents profit. Yeah, let me take a look at that. FVRR. So I have the number over here for SPX, so I can take my eyes off it for a little bit. Now I am accepting the risk up front. I am okay if this goes to $0. This is kind of just an entertainment trade at this point, and I can always just add 30 bucks into the account if we want to bring it back. So again, don't copy me, guys. This is just to show you kind of what SPX can do. Okay. So SPX, FVRR. What do you like about this company, Mr. Noob? Like, what specifically are you seeing? So, I've got an area of violence here. I've got an area that catches violence here. I've got another area of violence here. So I've got two zones that are kind of stacked on top of each other, and we're kind of coming out of that. Now, I've also got some zones that are very, they're nearby, right? So this is a very messy chart, in my opinion. So, if you're looking to trade the gaps between these zones, it's decent enough. Like you get $1 or $2 between each of these. But I would be very cautious about, this kind of stock. It's very difficult for this guy to hold profits. You're looking for 30 to 31. Are you looking for entry, or are you looking for 30 to 31 as your target? Like, what kind of time frame are you looking for? Are you looking for a breakout above 30 into the higher ranges up here? Or are you looking to trade it from like down here up to here? Take profit? Okay. So in that case, I don't see anything wrong with necessarily opening a position in this area and maybe adding a little more down here if you're okay with the risk on a small position. Just looking at the chart, I haven't looked at the financials at all. But I wouldn't want to hold it down here below, 19, for example. So it really boils down to where you're going to put your stop loss. So where would you like to put your stop loss on this one? You entered around 24, so you got in nice and low. You got in like down here in this gap. So I would say you got a pretty decent opportunity there. Were you able to lock any of those profits in around 28 when you were up $4? What's that one? That's about 16, 17%. No? What kept you from locking in maybe like the majority of your shares or half of them just to guarantee a net profit? Was that part of your plan, or do you just was that something you just didn't know you could do? You're going to sell half, but just hesitated. Okay. Well, what kind of stuff caused you to hesitate there? Was it like the what if? Or was it was it not good enough profit? There's no wrong answer. This is confession hour, basically. The what if. Okay. So what kind of specific thoughts fueled that what if? Were you like calculating the dollar amounts that you could have had? Or was it, did you factor in other trades that lost that you're trying to offset? You're like, I can make all this profit if it just does this one thing this one time. What if it goes to 30s? Okay. Were you like pre-planning what you wanted to do with that money? Like how strong was the expectation, I guess? Let me just check back on SPX here. It's kind of sitting at, there we go. Look at that. Nice violence, guys. Now, because I'm farther out on my contract, it's going to take a lot more juice for it to get up into the range where that contract has value. Because remember, my contract is way up here at 6,700. So it's over the highs. But again, on a day like today, those kind of highs can absolutely be punctured. So I'm not looking for a little tiny move here. I'm looking for a big substantial move. And that's how you get those triple digit, quadruple digit runners percentage wise. Now, whether or not the price wants to shake and hang out sideways because both sides are fighting with contention, I don't control that. I'll get back to that, Mr. Noob. I just wanted to point this out because it broke out of the box here really quick with some violence, which is nice. I don't control whether or not this moves in the direction or if it stays sideways, right? That's a choice I have to make. The choice I have to make is my reaction to that. So how do I respond, right? Do I want to sell this for a nice tight profit here at 20%, which is great? Is good enough good enough? I would say so. For most traders, I think if you're trading SPX and you're new to SPX, you can get 20 to 30% most of the time. I can't say most of the time legally, but a lot of the time you can get 20 to 20% on these little cheapy contracts. But you can also get 100% loss most of the time. So it's all about when you take the profit, when you cut the risk exposure, and that's a decision you have to make on your own in the moment, because that 600% up can turn into a 20% down in a matter of seconds if you don't lock those profits and the price just happens to stagnate and falls off. And then it's that regret that kicks in and it hurts us, and then we fight ourselves over it. So, sorry. So let me just kick this back to Fiverr, FDRR. So in this case, I would say we kind of want to have a plan in place so that we don't rely on our impulses and our anticipations, right? What if is always rooted in anticipation by definition, right? We're expecting something. We would like to see something happen. We have a scenario that we want to achieve, and we want to live in that future end result. And when we can't, we endure cognitive dissonance because we're unable to meet that need, and the brain doesn't have resolution, and that throws a panic signal and everybody gets upset, right? So that's where having a plan ahead of time comes in, and just kind of begrudgingly accepting those profits when they're there, even though they're smaller, and saying, oh, you know what, I'm okay with this. I'm comfortable enough with this. Let's lock it in. At least we guarantee a net profit and we don't watch this turn into a loss. So the what if skews heavily in the profitable outcome. And that's where it gets dangerous, because if you're not equally weighting the what if for the loss scenario, it becomes a lot harder to accept those profits, because if I can take 10 of my trades, okay, let's say half are wins, half are losses. I'm net profitable in that scenario because I'm using a greater than 1-to-1 risk reward ratio. But let's say that I want to take 7 of those trades instead and make them profitable. I'm even more profitable. So I still get the same end result. I've just done it in a more responsible way, because 2 of those trades that would have lost, I could turn into winners if I just lock in the majority of those shares and guarantee myself a net profit ahead of time. And then I have a smaller piece to run for the what if, and that's okay. I don't need to squeeze every single drop and every single penny out of it for the what if. You know what I mean? So let's watch and see what SPX does here. It's showing some violence here back into the zone. Chris M up 30% right now in 0 days, 665 calls. So you got the SPY side of it. That's awesome. Were you able to lock any in, or do you plan on holding it? PB, yeah, we've had some fiber plays. We like it. It's a channel trade though. It's not like a that one mostly ranges, so it's not really like a displace and continue kind of thing. It's mostly just it's going to chop in certain zones, and we just kind of get it when it's moving in one direction, and then we cut it as soon as it stops doing that. Not expensive contracts, so feeling some FOMO today. Okay, so what's fueling that FOMO? Top is trading SPRC. Yeah, let's take a peek, man. I like that. So we've traded the hell out of this one too. Are you looking for a break of that high? Maybe a shoot over 8? Again, this transitory zone, guys, they're very nice. You got your reversal zones, your catcher's mitts that throw the ball back, and then you've got these transitory zones. So this, in theory, should be transitory because of the way that the price behaved up here. There was no consolidation here. It just kind of reversed immediately, which is fine, but it didn't catch. It wasn't sticky. So when the price comes up here, it just makes a decision, basically. And that's what I mean by transitory. Most of the time, transitory zones just get pushed through in either direction. So think of it like a function. If it enters here, it should exit here. If it enters here, it should exit here. But we really want to see them get sticky. Like, see how this one stayed sticky for a long time? That is a reversal zone. That's what keeps the price. And then it makes a more confident decision in the opposite direction because it shows a battle, right? It's that wall of bodies that it can't climb over. So let me peek back at SPX here. It looks like we're getting a little bit sticky here. So let's see if it wants to hold up. See if we get a buy up. That'd be great. If not, that's okay too. And we'll see what it does. You're back down to only 2%. Yeah, those contracts get pretty violent. It's the IV, basically. The theta is a factor. It really ramps up towards the end of the day. So contracts are actually less efficient into end of day because it's like a curve. And then the IV is really the big factor in the morning because you got all that volume pouring in, and that skews the forecast of that stock's potential or that contract's potential as it kind of ebbs and flows. Sorry about that. Popping up a storm. So yeah, we'll see where it goes. I'm still pretty confident in a bullish move. We just got to get some of that strength out of the zone. And then once we break over this guy, we should see a nice clean push. And that's when that contract will really start to pick up in value. And I might, depending on how long it takes, I'll probably lock this contract in here just because I don't really like holding SPX too long now. There are obviously arguments to be made about higher pushes. And if we get a decent enough return and we approach this zone with some strength, I don't mind holding it for longer. But if it kind of putters around up here, or if it kind of starts to reverse, I'm just going to cut it. Same with this one up here. You know, I'm not too interested if it just hangs out here. You know, there's no real reason to cut it there unless it's turning around there, and then I don't want to cut it. Or I don't want to hold it. Sorry, I do want to cut it in that case. So we'll see. So my original bearish thesis has not come to fruition. My bullish thesis has shown a confirmation. So that's the direction I took the trade. This is the advantage in not having a bias, is this contract has been up to 30%, pretty consistently above or at 12%, and it didn't take a whole lot to get there. And then, of course, that's all time. If you count the number of minutes that we spend in profit-taking territory, we don't really need a whole lot of bullish support for this to gain value in the contracts. And that's because we're a little bit farther out, and because there's going to be a little bit more commitment when people start to commit. That's going to, it's kind of hard to explain. Think of it like Costco, right? Rather than a gas station where a vendor might come in and, open a box of honey buns and put them on a shelf or something. Whereas at Costco, they're going to bring in a pallet, right? But maybe they have to go farther away to get to the Costco. And that's how these contracts are. When it's time for the price to be up here, when it's time for that delivery, there's going to be so much more gap on the value of that premium, and same for the downside because they're so much farther out that the potential on dollars risked is exponentially higher than if you got an in the money contract. So the trade-off here, sorry, is that if you take in the money or at the money contracts, you're going to have a higher probability of profit, basically. I mean, it's going to lose value a lot less efficiently, which means it's going to hold value. Your profits will be a little bit more capped, but they'll still be more achievable. And if you go farther out, you're going to get a lot more bang for your buck, effectively. But the outcomes are a lot less frequent, if that makes sense. Mr. Noob, yes, this is Weeble. So I do have a change the color scheme on this one, just so that like the red and green, they're very close in terms of the value. So it makes it difficult sometimes when people are colorblind. So I use red and white because it provides a higher contrast. What do I recommend? I always recommend Weeble personally, but I can't tell you what to do. There's a lot of factors that go into it. I don't know all of your circumstances. Plus, I'm not familiar with the other one that you just mentioned, Future Bull. I assume that's for futures trading. Futubul. I don't know. I know Weeble. I like Weeble. I know Robinhood. I hate Robinhood. I know Thinkorswim. I like Thinkorswim. There's a steep learning curve. So Weeble's a happy compromise. And if you live in the US, it's free to trade. There's no commissions. You do pay little fees here and there for like options, and there's like a 1 cent fee. Those are FINRA regulated fees. That's not something the broker can do anything about. And they're negligible in most cases, unless you're trading on like a $3 account. Yeah. Most of us use Weeble. Weeble also allows you to have two accounts, one margin, one cash, or however you want to divvy that up. But again, it depends on your circumstances. Like not everybody is going to have a better time with Weeble. You know, if you have accessibility issues, or you know, if you're not as tech savvy, or if you just don't like some of the features that Weeble has, or you can't use the features, maybe you don't live in the US. You know, I think I already asked you if you live in the US and you said yes, but you know, there's other factors that you might want to consider. You know, there's how much money do you have? Like what kinds of things are you trying to trade? You know, like not everything can be traded on Weeble. So it just kind of depends, you know. So you got to just do some shopping around. We can help you, but I can't tell you definitively that this will be better than that for you specifically. You know what I mean? And it's the same with stocks. I'm never going to tell you that a stock is worth buying, or that you should do this or should do that, or you should sell that. It's not legal and it's not ethical for me to tell you that, because I don't know your financial circumstances and I don't know your personality traits the way that you do. I can help you discover them and put labels on them, but it's you and your circumstances. You're trying to get rich, you're pretty young, trying to stay away from volatile stocks are risky. I don't blame you, man. Your number one job in the market is to preserve as much of your money as possible. I say that as I'm trading a 0-day SPX trade. So again, don't copy me. But the end result is the same, right? This money does not affect me. It's a very small account. I've been doing this for 15 years. I get it. I accept the risk ahead of time. I know the potential as well. And that's what I'm here for. If I take a hit, I take a hit. It's okay. But I didn't get to where I'm at by trading SPX 0 days all the time, right? So worst case scenario is I take 100% loss on this. I lose 25 bucks plus the whatever dollar fee or whatever. And then I can use that towards my taxes to offset my capital gains. So still net positive for the year. And I'm still doing pretty well for the year because I've set myself up a solid foundation of passive income that has compounded. And it gets a little bit obnoxious after a while, but it's money I don't have to work for. So that's the goal is I don't believe in the grind. I don't believe that the market is something anyone should be prioritizing. It is a side hustle that eventually impacts your lifestyle if you do it the right way. And the right way does not require taking super high risk trades and staring at charts for hours on end. That is a lie that has been fed to you by Weeble gurus or YouTube gurus, sorry, and by institutions that have literally handed you their playbook in the form of these YouTube idiots for the purpose of fueling the bad habits that most traders bring to the market. So again, I say all this while I have an active SPX 0-day open, so kind of separate the messenger from the message here. But think about it logically. If I am an institution, right, My main enemy here in the market, my main goal is to absorb others, the resources of other institutions. I want to consume as much as possible and get as big as possible. So what am I going to do? I'm going to go after their clients, right? I'm going to say, okay, here's, I'm going to publish some things, okay? And I'm going to say, hey guys, here's one of my traders, right? Here's one of my successful broker agents, my successful Wall Street guys. He's phenomenal, right? Think of like somebody like Tom DeMark, okay? Great trader. Let's publish a strategy. Let's publish an indicator. And then all the YouTube gurus are going to want to be like Tom DeMark. They're going to put so much faith and so much effort into his strategy, his concepts, his indicators. And it's not to say they don't work, but most traders lack what actually matters in making that work. And that's the psychology and the portfolio structuring and the position allocation management and understanding the market the way it is rather than the way they're told. So if I'm an institution, I have a vested interest in most people following some set of rules that I hand out to the masses, right? Because there's going to be inefficiency, and that inefficiency is going to be something I can scrape every day consistently, and I can pull money out of people's pockets if they give it willingly, right? So if I'm an institution, I'm going to teach you guys the wrong way. If I had to use something like the Fibonacci, or how to read the order book, or how to use the TD sequential indicator or something, I'm going to teach you guys differently, right? But I'm going to make it make sense. And this is why I want you guys to scrutinize everything, even the stuff I teach. I'm going to teach you guys supply and demand wrong. I'm going to teach you volume wrong. I'm going to say, you know what? The price moves up when there's more buyers. And you're not going to instinctively say, well, that doesn't make any sense because every transaction requires a buyer and a seller, right? And the institution's not going to answer that because you can't talk to the institution. You're going to see it on a YouTube video from someone like Chris Sane or Oliver Velez. Don't come after me for copyright, whatever. And they're going to say, this is about to push up because there's more buyers. Buyers are stepping in. That is not a legitimate concept. It doesn't make sense. But most new traders don't have someone to slow things down for them and say, that's not actually how it works. Because what actually happens is price moves up when someone places an active dominant order on the ask side, and it gets matched with a lesser order on the bid side, and it moves the mid price up because every transaction requires a buyer and a seller. It has to be equal, otherwise there's no match. And again, that's not something you're going to see on YouTube, unless it's like one of my videos, because they don't want you to understand it the right way. They want you to understand it in a concept, in a way that oversimplifies it so that you don't have a proper foundation. They want you to kind of stand on shaky ground so you're confident, but you're not efficient. And then that's when people get hurt. And I hate seeing it. So again, the institutions have a vested interest in teaching, and they're going to publish things, and then YouTube people and quote unquote trading personalities are going to go out there and quote unquote research these things and understand them. And they're not scrutinizing the source, and they're just learning things slightly erroneously. And then they're simplifying them and further diluting them. And then they're blasting them all over on YouTube next to profit porn and saying, see, this works, this works, this works. When in reality, they're just teaching something wrong, and they're providing confirmation bias. And my job is to help you guys develop a mindset that focuses more on protecting your money than trying to go out and chase profits first, because that's always the hardest challenge. And then it's to get you guys to focus on scrutinizing everything that you see and hear in a healthy way. Like, don't mistrust your spouse, but in the market, if you see a concept or a strategy, go paper trade it. There's nothing wrong. You don't lose anything other than a little bit of time, to learn something and collect the data. And that's something that most traders they're not willing to do because they're so busy trying to live in that end result. They're trying to get rich quick, and they're trying to make it and figure it out. And they got just enough confidence and just enough resilience to push them through, deposit after deposit after deposit. And it's a very frustrating cycle. And eventually the deposits are no longer worth it because the value that they're attributing to the cost does not balance out, right? You're paying the market either way when you lose. Every time you lose, you pay the market. If you're not assigning a value to that cost, you are just sacrificing money, and it sucks. Now, with that said, you do get those back at tax time in most cases, as long as they're not wash sales and other conditions aren't met. Yeah, I got to brainwash him a little bit. Sorry, Charlie. I'll read through the chat here in a second. But I want to make sure that this mindset and this approach makes sense to everybody first, because it's way more important than any trade. So again, actually, I'm going to open up this Miro really quick while that SPX thing's going on in the background. Oh, no, I don't want that. I don't want to be elevated. No, thanks. So if you don't have an engine like this, and I know that people that have seen my streams are probably sick of seeing this thing. It all starts with financial security outside the market. I'll keep this super succinct. If you're constantly depositing paychecks and your bills and debits, your debt, is constantly growing and your profits are not, you're going to have a hard time in the market, because this brings in so much extra stress and desperation. We can skip all that just by being financially secure. Build an emergency fund, establish good credit. It doesn't cost extra money to build credit. That's a lie as well. You don't need to utilize heavy debt. Actually, you want to use as little as possible, have access to as much as possible. And just make sure that you have clean visibility of your budget. Your inflow and outflow have to be perfectly understood, and you have to be optimizing things. Take advantage of loyalty programs, take advantage of promotional offers. People just don't put in the effort because they don't prioritize it, because they're so busy focusing over here on the speculation that they hurt themselves. As soon as this is financially secure, you've got a pathway to consistent contributions. Therefore, passive growth can be possible. That is one stream of revenue into your portfolio. Then, if you put most of that stuff, I put 70%, everyone has their own ratio, into passive income yielding and compound growth positions. Those provide payouts, which can be reinvested. And that's two streams of revenue into your portfolio. Let me just check back on this. It's pulled down a little bit. And then you take the remainder of that and you put it into speculation, the fun stuff. And if you, break that up and you have proper position management and proper, position allocation structure in place, that should give you some combination of finite outcomes, right? So in this case, 4 out of the 6 potential outcomes are positive, 2 are negative, and they're controlled, right? And that's sample numbers. It would be a ratio. All your losses in theory could be used as tax advantages. You get to offset your capital gains with capital losses. And there's some caveats, so I can't give you tax advice. I can just provide general education. But all the profits can be reinvested into your portfolio, which is a third source of revenue coming into your portfolio when you've only contributed one of them. And that's the advantage of having a clean, contained system in place that most people don't put any effort into building just because they don't know any better or they don't care. So I'm done rambling as far as that goes. But that's something that we can all build relatively easily by just slowing the hell down and focusing on what makes sense, right? So don't spend all your time focused on charts and don't spend all your time focused on technical analysis. That's not going to be your path to success. It's going to be fun. It's going to be frustrating. It's going to be discouraging. It's going to be euphoric. You're going to have a lot of mixed results. You're going to have some good results, some bad results. 90% of people have bad results to the point where they can't trade anymore or they don't want to trade anymore and they leave the market. I want you to at least be in the top 10%, but I don't want speculation to be the end all be all of what you do in the market, because that's not how you make it. Eventually, even if you just speculate, you're going to run into liquidity issues. You can't shove $250,000 into one fill on a 30-cent stock. It just won't happen. Your buys are constantly going to move the price up, and then other people are going to start selling, and you've become exit liquidity. Congratulations, because you're too big. You can't participate. You can't play in that pool, which is why you see accumulation zones and displacements and things. There's chain fills and exploits and things that institutions use to consume each other. And eventually, if you're big enough, they will consume you using the same exact thing. So you're going to have somewhere for that extra money to go, even if you do really, really well at speculation. And that's where passive income is kind of, I don't want to say it's unlimited because it's technically not, but it's a much bigger pool. It's the ocean, right? You're talking about trading in maybe a bowl of water compared to the Atlantic Ocean, right? Passive income is going to be the way that gets you there. And then at some point, the passive income that you generate just from the dividend yields and the growth of the stocks and things like that you're holding in your long-term investments, that's going to outpace your contributions that you're making from working your 9 to 5. That's not going to replace your job at that point, but it'll fuel the fire. And at that specific point, there's a crossover where that compound growth increases drastically. And that's where I want to get everybody to before they get into all the don't just do a bunch of SPX trades. This isn't it, guys. I'm telling you. The low float stuff is fun. It's not going to make you successful in terms of, I can pay my bills. I am financially free. This is not the way, because you're just trading one job for another, because you're going to have to work harder for it the bigger you get. And that's not the solution. Yeah, exactly, Fergie. Passive income is the goal that speculation helps you build. Absolutely. Perfectly worded. So let me catch up on the chat here, because I've rambled enough. We're still just waiting for SPX to kind of pick a direction. We keep coming back into the zone and then kind of pushing out of it. So we'll see where it goes. Let me just, you guys chat a lot. I love it. Keep chatting. Top is in here just crushing it as momentum trades. So I'm not trading any of those today, Top, unfortunately, but I wish you the best, and I know you're going to do well. You have a very consistent and disciplined approach, and I love it, and that's what people need to see. I'm just doing a one and done on SPX today. Porter says, oh my God, my computer's going to crash with this note taker program I made. Need to get back to Thailand to use anything more than the small model. Why don't you use something like Google Docs so that there's less load on your computer? Or parse it up if you can. Yeah, exactly. If you haven't seen Monolith, his name was Crispy, previously the artist formerly known as Crispy. This guy is absolute proof. He's had some, he's made insane amounts of progress in a very short period of time, and I love it. And that progress is sustained. So he completely changed his approach, and I love it. To the market, as well as I'm going on a limb here, and I'm going to say life. I feel like he's changed his life approach, and you can see the results. How much money am I putting in each of these trades and the live shows? So usually I have about 30 to 50 on this account, but today I'm just putting in basically 30, so 25 plus like a dollar fee or something, just to answer your question. Normally I put in I just buy like 1 or 2 shares at a time. I used to do 50% of the settled cash and do 2 trades a day. But people wanted more trades, and there we are. So now I'm kind of back to just doing 1 trade, kind of for better or for worse on this one. And you can see the end result here is kind of substantial drawdown on this one. So I don't have any expectations either way. So I want to make the risk very, very clear on this. I am perfectly okay holding this down to a complete loss if I have to for SPX. I don't want anyone else to do that on a substantial size position in relation to the size of your account. So I'm doing it. Let it serve as a cautionary tale if it loses. And if it wins, that's okay too. But it is a clear elevated risk. So I want to be very clear about that. Mr. Noob says, yeah, those people on YouTube, I feel like are scammers. A lot of them are. They're just trying to sell a course. They're not going to sit there and have the conversation with you. And a lot of times you also don't see the losses. Like here, I'll show you guys. I got nothing to hide. This is my tracker, my P&L tracker on this account. So if we do take a loss on this one, I'll probably just put like another 25 or 30 in like tomorrow or something. And it is what it is. I'll mark that on here. So it's 100% transparent. I have nothing to hide on this account. You guys can see the big losses that are holding this account, quote unquote, holding it back. It was up 16.15%. It was up, I think, like 30% at one point. It's just the big losses. And most of that's just from when I have to step away. I just straight up don't set sell orders because I just don't prioritize focusing on this account, which is good and bad. Like I have other accounts I focus on, but I don't focus on the market as much as, like a new trader. A new trader would sit here for hours and just stare at charts and like micromanage every dollar they have and use every single dollar and penny that they can in buying power. And you don't want to do that. You're putting in extra work. You're not going to change the end result by working harder in the market, at least not in your favor. So yeah, most of the time when you see people on YouTube, ask them where their losses are. Ask them to share. You're not going to get that. And I don't trust anyone that doesn't show me their proof of concept. There is a time and a place for a fallible mentor in life, but it's not going to be in the stock market when my life savings are on the line. If I'm a new trader, I want to scrutinize it. I want to ask, why are you telling me this? Why are you trying to show me that? and hopefully at this point I've demonstrated enough profitability for you guys to show that clearly this is just kind of a YOLO, right? But you guys know that I can make money in the market and I can do it consistently. And it's not just from this stuff. This is kind of a blow-off valve that I can use for taxes. So, Charlie, so this SPX trade is obviously not a scalp. What sort of time frame did you, if you have in mind for the trade? So this is it's going to be a bounce. So it's a range bounce. So you're correct in that it's not a scalp in its truest definition. And for those who don't know, a scalp is basically where you just have a level here and a level here, or actually disregard that level altogether. But a scalp is basically where price just moves in one direction. Now it should start down here and it should continue going, and you just catch it along the way before there's any stall or any hesitation, or as soon as that stall starts, you're just getting out immediately, no hesitation. You're just getting in and out. Usually it's like 0.5 to maybe 1.5% if you're on equity. That's like a true scalp. There's momentum day trades, which are pretty much just a bigger leg movement. That's a displacement. Like you're just trying to catch a little push, pull, push situation. That's different than an actual scalp. But we generally use the term, we use them interchangeably. So for this one, if you look at like the 15-minute here, I'm basically just looking for a range bounce out of this zone, right? I want to see some violence out of this zone, similar to how we saw over here. Into this range here between 66.63 to 66.77, and then depending on how price behaves, then I'll consider holding it above 66.77 31 for a potential move up higher and closer to my strike. Now, ideally, I would love to see a push over the high. That'd be great, but I'm not going to hold my breath on that. So I'm just basically looking for a break over that orange line over local highs. And then we'll see how it behaves, and then I'll go from there. Let me catch up on the chat. Yeah. Mr. Noob's indoctrination on the right path. Yeah. And yeah, exactly, Joag. That's a great breakdown. The strike, the contract you take, if you trade these 0 days, there is absolutely going to be different behavior between an at the money contract and a away from the money, like super far out contract, like a cheapie. Death Gun, EPOW from watch listed entry. This was, when did you write that? 10:07. So 10:07. So on Webull, that would be reflected as a 10:08 candle. All right, let me pull up that watch list here. So I built a little app that pulls those. So 143. That's the entry. Target on that one's 160. And then the stop loss here on that one is 135. Okay. So yeah, it looks like it hit entry. You had a little bit of profit opportunity there, and then it just looks like it pulled down a little bit. And sometimes that happens. We don't know if it's going to continue or pull back, but the entry opportunity was there. Was that a candle close? Yeah, it was. So yeah, I mean, I would say that's a valid opportunity. Sometimes there's losses, and that's what the stop loss is there for. Sometimes there's profits, and that's what the targets are for. So, yeah, I probably will just call you Crispy. Just that's how I know you. So, or Dan C. I'll always know you as Dan C. But I'll call you Crispy. I think it's a happy compromise. People are not going to know what the hell I'm talking about. Charlie, will you call out when you would cut it if you didn't want to hold it to 0? Yeah, I mean, 30% is always a hard cut for me on SPX that I don't want to hold. Obviously, a break below this low here on the price action would also be a hard cut, but at this point in the day, because I've been holding it for almost an hour, when it gets down here, it should be below 30 anyway. So I would say at that point, either way. Big volume spike in SPY. Let's take a look. I'm still holding your, oh yeah, look at that. So SPY is doing the same thing. We're just ping-ponging, right? But the location of the ping-pong is important here, because what we have is displacement zone setting up, right? So if I go back to, let's say the 5-minute here, you guys see this consolidation here? You guys see this consolidation here? And this consolidation here? And this one? Like every time we get consolidation like this, and then we get a directional break, those breaks tend to be massive, and that's the displacement I'm looking for. And that's exactly why I draw these ranges the way I draw them, because I want to take advantage. Like right here, for example, this is from the 26th. So what was that, Friday? Yeah, Friday. So Friday, we saw the same thing, right? We saw it here as well, and then it pushed back up. We saw it here, and then look at that move that it made on Friday. You know, that's all I'm looking for. I don't need, you know, the whole move. I just need a good chunk of one, right? Now that's all I care about. So I've got a continuation one here, right? Similar setup. And there's a continuation one right here, just bigger. So theoretically, we could see a move as big as this, which would be a $106 move. I'm not going to look for that. I'm not going to expect that. But the setup is there. And if it breaks to the upside and gets the pickup and it breaks over this high, we could very easily see that, in my opinion. But again, I don't need to hope for that. I don't need to expect it. I just need to see the potentials there. And then I catch my piece of it along the way. And then I stop caring what happens once I'm out, because I have exited my risk exposure. I'm not going to keep working after I clock out. You know what I mean? And that's my job as a trader. So I'm okay seeing this chop, this volatility, because it's occurring right where I want it to happen. I want to see it do this, you know, as it continues to bounce off this level that is repeatedly showing strength. Like in theory, you know, it pushed down with some aggression into this zone and it bounced right back. It pushed down again and it bounced right back. It pushed down again and it bounced right back. So this zone that has shown, you know, pretty extreme violence historically and gotten us some nice bounces historically is doing the same exact thing today. And that's all I care about. I'm in the right neighborhood. I'm going door to door here. You know, I'm just waiting for the right door to open or for it to be unlocked. And then once we run, we go in there, we steal the TV, we take the keys, we take the car, we go to the next town over, we burn it under a bridge because we joyride is over. You know, we did the right thing. And most importantly is making sure we don't get caught. Uh-oh, your sound died? Uh-oh. Yeah, the name changes are rough. I play Overwatch with the wife, and people on there just occasionally change their names, and I just I'm so close to unfriending them. Oh no. Can anybody hear me? If you can, type Apple in the chat. Either the ticker or the word or something. Okay, audio's back. Sorry about that. Apple in the chat, nice. Sorry about that. My internet, it's probably just my router. I'm sorry, guys. Meta. I gotta get a hard line. Oh, my bill's paid. That's my stupid router. It's probably my fat cat sitting in front of the router and messing up the signal. Yeah, Charlie, that's what it is. We're name server hopping. All right, so again, we're showing some strength out of here, and let's see if we can break over this. Remember, this is the only thing I care about breaking right here. Just want to see this break. Then we should see a good clean pop. And then obviously, if we break above that, we've got much bigger potential. And that'd be nice, right? Not expected, but it'd be nice. So we'll see how that works out. And then if we can make a decent, so here's how it works, right? When I trade SPX, if I lose, that's okay. I'll write it down. I'll get to use it for taxes. If I win, and I win substantially, what I'd like to do is then either withdraw the profits and trim the account back down to kind of where it was before, or I'll take another future trade to take the loss so I can use it for taxes, and then still trim the account back down. So when I trade SPX for profits, I typically just bring the account back down unless I'm just trading on my own. But since I'm live streaming, I like to bring the account back down because I don't, I try to keep the end result realistic. And if I go out and make a $600 profit on a small account, you know, it's not attainable for most traders without them taking that kind of risk. And I don't want that to happen. So if I do make a big profit with SPX, I'll trim it down one way or the other, and then I'll bring it right back down, and that's it. JWAG, I don't get to put it again, Texas. I just get to survive on bread and water for the rest of the month. Oh no. Well, if that's the case, I'm going to go ahead and point out this this flow chart, Mr. Sir. We got this guy, Mr. Sir, Mr. Man, Sir Gentleman. We want to make sure that we're not eating ramen because of the market. So please don't do that. It would hurt my feelings. And it's just not healthy. And if you really think about it, if you're not healthy, you're not going to be around to trade long term, right? You got to take care of yourself. You got to take care of number one. You got to properly hydrate, nourish yourself, get some rest, go for walks, get some exercise. Try to stay mentally healthy as much as possible in this crazy world. Because you have to stay intact. You have to stay able, right? If you're not able to trade, it's just going to take longer. But you got to be there to enjoy it, you know? And I know you're kind of just joking and stuff, but that is a concept that is usually missed by a lot of traders. You know, it's very easy to just let the market in and let it dominate your life, but you call me an ableist. You need an eyeball, a prefrontal cortex, and a finger, sir, or some signal. It's the brain that counts. Yeah, exactly, Charlie. The account was designed to express that it really doesn't take much. You don't need a lot of money to make money in the market. And, you know, again, with that spreadsheet where I track that, you guys can see that. I don't have to take those big losses. It gives me an advantage, and then I have more content to show you guys and to show you guys what can go wrong if you don't prioritize putting stops in place, because that's my obstacle. I just don't put stops in place. Not because I don't know when to get out. It's just because I don't focus on the account. Yeah. So if I cut all those out, this account would be up pretty nice by now. But I want to keep that, I want to keep the account small and relatable. You know, there'll be a time when we kick in that rocket thruster and we blast up. You know, you guys have watched me turn 50 into like 2,000 or 3,000 in a matter of 2 weeks, you know, but I'm not going to do that every week. That would be insanity. And it would just compel bad behaviors from you guys. And I don't want that. And yeah, I don't want anyone to feel left out or left behind. You know, if you can afford $50, you can grow $50 with the right skill set and the right mindset. Which came first, this educating model or the $500 challenge? I started the $500 challenge about 2 years ago, and then it kind of morphed a little bit. So maybe I'll just save it for the last year or so, and then we'll just turn that 500 into 6K. You know, it doesn't take too much time once you have the skill set. And I know it sounds like a slap in the face for people that are struggling right now, but once you figure it out, it literally does become an ATM that you have. Like my computer, I just push buttons and I just get money. Sometimes I lose. And in minimizing that loss is the real value. You know, all I got to do is make my losses small and then let the profits happen. Very simple concept, but it's very difficult. It's even more difficult for new traders because they make it more complicated. And it really doesn't have to be complicated. You grow years from luck. Well, we got to work on that, buddy. We got to get you to focus on that financial stability first, and then your approach to the market. But you have the skill set. I've already seen it. You are insanely good at cutting losses. Everyone here has seen the profit channel. We've seen your results. And that alone is something that 90% of new traders can't figure out. And that's the only thing that's going to take you out of the market is losses. So once you control your losses, it gets a lot better. You think SPY's about to make a move? Yeah, I mean, it's primed. It's just a matter of when they're going to hit the button. They're going to try to keep it range bound and burn contracts and stuff, you know, as much as possible. But yeah, I mean, eventually it's going to break this diamond shape, right? We got a little bit of a situation here. So if I just draw this out, it's kind of funny. I guess like that would be the, you know, we got kind of one of these scenarios. That's like a bullhorn and a wedge forming back to back. I love it. But where's it forming? It's forming above my area of potential violence, and we're seeing repeatedly little violent spurts out of that area. You know, we got 1 here, 2, 3, 4, and then we see a lot of indecision just above that. But we see the violence, and that's all that I care about. I just care about the strength. So we'll see. Breckle blocked the profit channel. Zero need to look at it. Sorry, not sorry. I love that. Don't look at the profit channel. The profit channel's in temptation channel. I don't want you to compare yourself to anybody else. It's there for people to showcase and to, you know, to highlight their achievements, but I don't want anyone to feel like they have to, let me rephrase that. If you look at the profit channel and that prompts an emotion, or you have a response to that, you are putting yourself unnecessarily in front of impulse. You know, Chris M, we should do a loss channel. Dude, I've wanted that for a very long time. I've argued the merits of having that, and I would much rather, just personally, I would love to see a channel for accountability. Yeah, accountability. I would love to see a channel that is filled with nothing but super tiny losses, because I feel like that's the message more new traders need to hear. I don't care how big your profits are. I care about how small your losses are. And if you can consistently lock in small losses, I love you. Because I know where your future is. I know where you're headed. If you have a $300,000 profit and then a $310,000 loss, you're not profitable. But the image of that $300,000 profit is going to carry a lot more emotional charge for someone seeing it than a $310,000 loss screenshot would. You know, so it's, I desperately want a loss channel. I don't want a place where people complain about constantly losing and taking big losses. That's not what that needs to be. It needs to be a showcase for small successes, successful losses. You know, I would love that. I did talk to Austin. He's not ready to, that's a non-starter for him. And I get it. He wants the appearances and stuff. He doesn't want to see a bunch of people losing. And I get that too. But I would love to showcase small losses in some way, because that's where the real success is. Fast Soup, it's a great question. How did you take the emotions out of trading? I know you're solid now, but I'm sure in the beginning you were like us common folk with that heart race. You're being worried about what if. I actually had a really traumatic childhood, so not necessarily the same. So maybe that does kind of make me a little bit of a unique case, but that doesn't mean that there weren't still similar obstacles. You know, losing 80% for someone that grew up poor, right? I was homeless twice. You know, I definitely starved. I was malnourished. I was abused. Not to bring the room down, but there were some obstacles there. So having 80% of the money that I was able to scrape up and save, my meager savings at that time, I was working in fast food. You know, watching 80% of that disappear in 4 weeks was definitely kind of rehashing some of that trauma. It's like, oh, well, that's not sustainable. But I wasn't, like, my immediate reaction wasn't to turn to anger. It wasn't frustration. It wasn't despair. It was like, okay, well, this isn't working. What do I need to do to like stop this? I just wanted it to stop. I was like, okay, I got two choices. I can go talk to the guy who set me down this path and without blame say, what do I need to do to fix this? Or I could just stop trading altogether and just work harder and rework that that savings back up. But I knew there was potential in, you know, building that machine, and I didn't know all the ins and outs of it, and I just needed to know more. So I was like, okay, well, I can at least practice. Practice is free. I knew enough about reading charts that I could, you know, generally pick up on price was here and then it was here, right? So I just needed to figure out like what caused that and how I could participate when it started next time. And I just had to change my mindset mostly, because then I really looked at it. You know, I went back to him and I was like, hey, how did this happen? And he's like, well, how did it happen? And I was like, oh, because I was like, hey, I just lost, you know, most of my money. And he's like, well, how'd you lose most of your money? And it was literally a conversation. Like, I was very short. It wasn't exact verbatim, but it was basically me asking him, I was like, how the hell did I lose all this money? And he's like, because you risked it, basically. Like, it's, you know, you can't lose it if you don't risk it. So at that point I was like, oh, okay. Now, he was a horrible teacher. I'm not going to give him too much credit, because I don't believe it's necessary for someone to lose 80% of their savings for them to figure this out. You know, that's a very bad thing, in my opinion. But that's what he believed I needed to do because that was his way of forcing me to slow down. And he knew the market would do it for me. He knew that if I didn't have a bunch, I would have to slow down. But there's a better way. You could just, put a cautionary tale or two in front of somebody and ask them if what they're doing aligns with their goal of making money in the market. And, the Socratic method works just as effectively. And, the proof is in the pudding. A lot of you guys are focusing on making your losses smaller or have already turned your stuff around. You're focusing on passive income. There's a nice little buy up on that. I'm going to watch this closely. SPX. I almost said SPY. But I'm very interested in this candle, which means I will be very, very interested in the next two candles. So let me make those thin. Sorry, I didn't mean to cut myself off there. Yes, I did. We should be seeing our move here pretty soon. There was a definitive little chop in there. Plus what we're seeing here, this is an institutional signature, and this is a absorption. So we have absorption, 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 absorption with a violent impulse in an area of known violence. So we should be getting our push up or down here pretty violently pretty soon. So I'm going to keep a very keen, very close eye fixed on SPX here for the next 5 minutes. That doesn't mean jump in. Don't copy me. I'm just pointing out there's potential here for a nice drastic move in the next two candles here. Yeah. So, and anyway, I realized very quickly that losses are the only thing that can hurt you as a trader. And fortunately, that's the only thing you have control over is how big or small or how long you endure those losses. And once you figure that out, you will realize you're drowning in shallow water. And you'll stop dumping, deposit after deposit in there. There's nothing wrong with just trading one share of something. If it's like a $2 or $3 stock, just trade one share of it. See if you have the discipline to hit the button up or down to get out, because it's the same action. You're just cutting your risk exposure. You're just choosing whether or not you realize a profit or a loss. That's it. That's your job. That's your one and only job in the market, is just, do you want to walk away with a loss that's smaller than your profit, or do you want to walk away with a profit that's smaller than your loss? And you're going to have both. It's just a matter of choosing the size. Yeah, SPX does need volume. And again, to clarify, I am personally 100% okay with this going to a full loss. I am accepting the risk. I accepted it before I got in. Hopefully I was very clear about that when I got in. I don't want anyone to copy me, especially on a position size relative to the account that's this big. If you want to trade something on a smaller amount, I can't stop you, but I don't want anyone to copy me. And you got to manage your own risk on this stuff. Yeah, it's already gone below 30%. So if you were using that rule, you would have cut it by now. There's no need to hold this. We can always get back in, right? We don't have to trade these to death every single time. I have an advantage in doing that because this allows me to offset capital gains at tax time. And there's no wash sale on SPX. So I can do this into the end of the year a whole bunch of times and I'm okay. But if you're someone that hasn't made profits, a lot of profits for the year, if you're already net negative, you really don't want to be doing this, especially if you're over your max allowed deductible limit for the year. If you're, for example, right, and this is just general education, if you are filing head of household and you're single, your limit is typically $3,000 that you can claim with indefinite carry forward, meaning that if you realize a loss, a net loss, greater than $3,000, you can claim up to $3,000 on your taxes. And effectively it serves as it kind of offsets, right? So, and then that would leave you $2,000 for the next year because you can't claim the full $5,000 unless you're mark to market, which you probably won't be if you're just learning about this stuff. And I personally don't encourage that unless you have a dedicated reason for trading as a business. But we'll cover that later. There are some circumstances which would bring that limit down to 1,500. So you got to be mindful of that as well. So if you're already over that limit for yourself, it's, about to be October, you really don't want to be making a bunch of losses at the end of the year because you're not really giving yourself much benefit. You're just giving your next year's tax refund some advantage, or maybe the year after that if you're already way up, right? If, however, you're profitable for the year, right, and you're looking to reduce those some, then you would be looking to take losses in at the end of the year consistently. You don't want to take one big hit at the end of the year. That doesn't feel good, right? But I'll sprinkle in little tiny losses like this to offset various things, and I'm at bigger numbers, right? So I'm not worried about this. Like this offsets a capital gain, right? Very small one. So looks like we got our move. It just didn't go in the up direction for now. But again, we're in an area where there's historical violence, and this could just as easily buy to the upside. It could just as easily slam all the way to the downside. We don't control that. We can't predict that. What we can control is the risk, and I've accepted my risk ahead of time, and that's why I'm telling you guys, don't copy me. Okay, does that make sense? I don't want anyone to take a loss unless that loss can be used for a benefit. Sorry, I'm just trying to catch up on the chat here. Chris, looking like SPX and SPY will move against us. We don't have any way to know that, until it happens. It's currently moving down into my range, but it's still in the range, So I can't really call it either way. Charlie says, I had to step away at some point. You're taking the risk to zero for the example of loss only, or for the chance of flying through the gap? It's both. If it goes up, great. That's another capital gain I'll have to offset. But if it goes down, that's okay too, because I can use that loss to offset my other profits, or my other capital gains, I should say. Because selling a house, for example, that's a capital gain. When you sell a house, you are realizing a capital gain that can be offset as well. There's various forms of capital gain that we have to consider, and that's why it's important to sit down and have a conversation with a tax guy or a tax lady if your tax person is not a tax guy. If your finances are complicated, pay someone else. Sometimes it's worth it to just pay someone else to take all the complicated stuff off your plate. They know a lot more than I ever will. I studied the tax code. It's complicated, million plus words, and it's all very messy because they can't reduce it. Like it's something they can only add to in a lot of cases. So to remove something, they have to add something saying that this is no longer valid, and they're replacing it with this. It's a whole big cluster, and it sucks. So you're traumatized by house sales, can't dodge a tax man anymore. Yeah, it's rough, man. It can be pretty bad. But again, if you sold a house, a lot of that stuff can be offset if you just understand money. That's like understanding debt. Debt is tax-free. So if you use tax-free money to provide tax-free gains by offsetting the gains with losses that are proportional and smaller, you get free money flow. You just get tax-free money, and then you can do whatever you want with it. And that's kind of the whole mechanism of the market once you get to the higher level. I can borrow money, right, at a favorable interest rate, obviously, and then use that money to do something, to acquire something, and then collateralize that for further debt with a favorable interest rate, and then pay off pay down the original, amortize it. And then I've got a huge established line of credit and all this tax-free money that I can do pretty much whatever I want with, as long as I pay off the interest and some of the principal as I go, or if I pay off most of it. But I still want to leave some, right? There's all kinds of stuff I can do with that tax-free money. One for you, 19 for me. Yeah, exactly. Taxes suck. I don't like the IRS. I'm not shy about saying that, and I hope they fight me in the parking lot. I don't care. The IRS is predatory. It is a parasitic agency, in my opinion. We don't get what we pay for. The idea of it is solid. I support the public funding of services and representation, but we're not getting what we pay for. So my goal is to help, as much as I like kids, I want your kids to have a better Christmas than the IRS agent's kid. That's my job. If you're out there begging and scraping and eating ramen and you can't get a bike for your kid, and his kid just got a new car that he can't drive for another 8 years because he's 8 years old. That's a messed up system, in my opinion. And I know IRS agents get salary or they get hourly pay and stuff, so it's not going directly in their pocket, but you get the concept. The IRS took down Al Capone, but why'd they take him down? Exactly. IRS is a scam. Again, I support the concept of it. I do believe that a nation should be funded by taxes to an extent, but there needs to be a very high value on the tax payments. If you're gonna ask for a high cost, you need to provide a high value. That's just fair. There's going to be an attrition. There's going to be inefficiency because you are paying a manager effectively. And I know that the IRS doesn't manage it, but they manage the collection and the implementation of it. You'll get nothing and you'll like it, pretty much. But I like getting what I pay for. It doesn't make me selfish or entitled to want that. Again, I grew up poor. I know what the value of dollars are. It doesn't feel good to just pay unnecessarily for something. If I had a subscription that I wasn't using, like I just recently found out I had 2 Hulu subscriptions because I was paying for one and the wife was paying for one, but we just have a couple TVs in the house. I canceled the second Hulu subscription. It just doesn't make sense. We always watch it together. It just, and that was $20 or $18 or something. Why would I want to be comfortable spending hundreds or thousands of dollars in taxes every year for less? At least I could watch shows on Hulu. We get roads, maintain them. I get it. Take my trash away. Give me clean water. I get those things locally. But there's so much extra stuff in the government that we just don't, there's no benefit. It's just shells and fronts, so private companies and other entities can get their little skim payments, and it just sucks. So I'll stop preaching, but you guys get the idea. Like, your goal is to deprive the IRS as much as possible while still playing by their rules. Because that extra money that you don't give to the tax guy can go right back in your portfolio and reinvest and speed up your process and change your future sooner. So, okay, now I'm done preaching. I was like, I'll stop preaching, and then boom. Can you imagine if the IRS was commissioned? That'd be insane. Technically they are, right? They're funded by tax dollars. So it kind of makes sense that they have an interest in collecting tax dollars. Abort mission, they're on to us. Did I sign up for Rocket Buddy? Or are you asking somebody else? Me? I think I have it, but I don't really use it as much. The double sub. No, I actually have a spreadsheet. It's just a spreadsheet. Rocket Money's cool. Like, it does help for some of the subscription management, because one of the features is that you can like once you connect your accounts and stuff, and it identifies all your stuff, you can do like single click cancels and stuff. So that's cool. But I don't mind. I would literally pick up a phone and ask someone if they have promotional offers, like AT&T, for example, or Verizon. I'll call them and be like, hey, I like your service. I've been with you for a while, but I will leave if you don't give me a promotional offer. And most of the time they will, so it is what it is. But no, a spreadsheet can take care of your budget stuff pretty effectively. I just think that I think a tool like Rocket Money is useful for someone who doesn't know how or doesn't want to maintain a spreadsheet. The trade-off is you're giving them your data, and that's okay. I mean, they're not gonna go out and commit fraud, but they're still getting your data. They're getting your commerce information and your emails and bank information and stuff. They can't use it, but they still have it. They can map out like commerce clusters and things like that, and then they can really focus their advertising and all that. They don't teach that in schools, and I'm trying to get this into schools. Just the financial literacy stuff. I know Austin's doing a lot of work in the recovery space, and he's got a program that he's trying to launch through the state of Indiana, where it's where he teaches like prisoners and then people who are about to get out, teaching them financial literacy and life skills. You know, that it's just needed, and that's the kind of thing that tax dollars can and should be used for, in my opinion. You know, public service, like teach people how to be part of society and teach them how to, you know, be efficient. You know, and you're going to have a much better society that way if people are less desperate, or if you can at least take a couple people out of that cycle. You know, that's less of a burden on the system. It's just common sense. Just be a little proactive instead of reactive, and we'll have a better time. So yeah, it looks like we're still, like, it really likes the zone, right? You can see this transitory level here. It just loves that. It loves just chopping through that. So I'm not getting my fifis up just yet, but it's another show of strength. They're just trying to keep the price controlled so they can burn contracts. It is what it is. Eventually it'll release up or down with some intent, but it's got to go below this box, or it's got to go above this line, in my opinion anyway, before it is clear and decisive. So I'm just going to keep hanging out with you guys, and we'll see where it goes. Yeah. I think, Charlie, they offer, I think they can like negotiate rates and stuff for you too. I didn't do any of that stuff on there, but it might be worth looking into. Again, if Netflix, for example, starts a new promotion and you've been with them for like a year or two, and something like Rocket Money can get you on that discounted rate without you having to cancel and go through a bunch of hoops and stuff, it makes sense, you know? But it also makes sense to spend maybe 20 minutes on hold and have a 5-minute conversation to see if someone's willing to just do that. It's all about how you talk to people. Yeah. I sweet talked somebody at my bank yesterday. I was like, hey, how's it going? Like, just talk to them like people. You know, I've worked in a call center. I know it sucks. It's not a fun job. You're in like a little chicken coop and you got a bunch of people yamming around you all day, and you got angry customers and people that don't want to be called, and that sucks. You just got to talk to them like people. You've been with that. Oh yeah, the DVD mailing. Oof. Yeah, that's a throwback. Oh, Netflix, you silly goose. Do you remember Hollywood Video tried their Moonbeam? Do you remember that? It was a service they tried. It was before Redbox and all that. I used to work for Hollywood Video. It was a great place. Our store was crushing it, but the chain brought us down. We had to close. I worked there after Moonbeam though, but I heard about it and I heard it was a spectacular fail. They still mail DVDs. Yeah, that's pretty cool. I think one of the smartest things game console manufacturers did was implementing the ability to watch movies, DVDs. I think if they were strictly game consoles, they would not have sold nearly as much as they did. It's a bold claim, but I'm willing to fight the PlayStation execs in the parking lot. I'll do it. Wait, let me see how old they are. Hang on. I got it. Who's the CEO? Oh yeah, that guy. Yeah, he's out of shape. We're good. I'm just kidding. He's older. Sony Interactive Entertainment. Let's see. He's just actively plotting to fight a man on the internet. Huh. What's his net worth? Maybe I can buy him. I'm just kidding. He doesn't have one. How about his age? Is he old? Not specified. This guy's got a good profile. It's locked down. He doesn't have his age or net worth on the internet. He's a CEO of a multi-billion-dollar company. I can respect that. Yeah, exactly. The PlayStation was the cheapest Blu-ray player available at one point when Blu-ray was just getting started. Absolutely. Netflix tried to sell Blockbuster back when they started, and Blockbuster left. Well, hindsight's always 20/20. Is that one Blockbuster in Oregon still active? Didn't it get like bought or something? Yeah, Bend, Oregon. I think it's just the one franchise store. I thought they sold or something. Oh well. Not my problem. I remember scooping up a Blu-ray player for $100 and thinking I was a steal. Yeah, the pawn shops, man. Alaskans go there. They take their boats down to Bend, Oregon from Alaska just to rent a DVD. They got to bring it back in 2 days. Just out there paddling their butts off. It's a struggle. That's why I'd never want to live in Alaska. I got to go all the way to Oregon for movies. Breckle, you better plug that in. Takek, when the first DVD players came out, I won in an online contest, but we didn't have any DVD movies yet. Yeah, so congrats. Here's something. That's awesome. At least you won, right? All right. Looks like we're kind of making a little bit of a juicy attempt here. It's got to sustain, though, on SPX. And then we'll see where it wants to go. So, phone's going to Valhalla. Oh, no. Is it a Sony Ericsson? It might be with that kind of battery. Just kidding. So, Brecco, where do you typically charge your phone? Just curious. Oh, sorry, I just got a DM here from Bull. Let me just catch up on that. You can see kind of the same thing. Now it's settling a bit higher than SPX, like it's not selling deep, which is kind of good, right? Because, oh, sorry, SPX versus XSP. So you can trade SXP or XPS. I don't think I can on Webull. Are you talking about the minis? Is that what you're referring to? The SXP, I think it's called. Yeah. Okay. Oh no, you wrote XSP. My bad. I'm just dyslexic. Yeah, I mean, we could trade those if you want. They're cheaper, right? So the trying to think of a good way to explain this without going down like a futures rabbit hole. So yeah, basically these are tiny versions of SPX. So if you didn't have a whole bunch, like if you wanted to get it closer to the money contract and you wanted to use a smaller amount, you'd just come over here to XSP. Now the volume's lower. There's still plenty of potential on these. It's just less popular, so getting filled is a little bit stickier. And you know, I've traded the hell out of these, you know, historically, but there's just better potential on SPX in my opinion. There's also higher liquidity, so it's a personal preference. But I do like it. There's a time and a place for it, so it's a safer alternative, I guess. Spreads on XSP specifically can be pretty lucrative. Doesn't it have the same type of wash sale as SPX? So SPX is an index, which means it doesn't have a wash sale. The wash sale rule does not apply to indexes. Now, if I look at XSP, you'll see something specific. This is also this. I believe this doesn't have a wash sale. It's an index. So this is the mini SPX index. So let me just confirm that really quick. If actually, let me just Google that. I'm pretty sure it should be an index if I remember correctly. Yeah, Yeah, I mean, I'm sure it's also, these are also European settled cash only contracts. But let me confirm that the exchange itself registers it as an index. Yeah. Okay. Yeah, it is an index. So same rule applies. There will be no wash sale on that. That's why I use it towards the end of the year. I don't want to start a bunch of wash sales. So I'll trade SPY early in the year and then SPX at the end of the year for just wrapping up those last losses. And wash sales release, like it's not a forever thing. You know, it's just disallowed, and then it's added to the cost basis. The unrealized, the disallowed loss is added to the cost basis of the next trade or any existing shares until the window closes, and then it's just released. So it's not the end all be all. You just don't want to take a bunch of wash sales through the new year, right? So no wash sales in December, unless there's also an advantage in doing that too. So again, it really just depends. You know, it's a disallowed loss, but it becomes allowed after the turn of the year. And again, I can't give you guys tax advice. I can just give you general education. But there is an advantage in carrying losses forward into the next year's tax cycle. Just mentioning it for people that have maybe a smaller portfolio and don't have the funds trade in SPX, because those are pretty expensive. Absolutely. Yeah, I love XSP just for that. Now, the trade-off there is going to be the lower liquidity, the lower profit potential, and the, well, I guess that really kind of encapsulates it. But yeah, I mean, it's a great alternative, just like the ES minis are different. You know, and yeah, you can always do a spread on SPX if you're unsure about it. You can also do a spread on XSP if you really want to make it cheap, and you know, you're going to have capped profits in a lot of cases depending on the type of spread, but it's there. You know, you can always do that. And actually, I think it might not be a bad idea to run one of Bull's calendar presses on XSP. Traders Paradise people. Cough, cough. Cough, cough, wink, nudge, aggressive nudge. Coughing, more coughing. Just hacking up blood at this point. You guys get my point. Consider it. Practice it. Paper trade it. Don't do it. Paper trade it. I can't tell you not to do it, but paper trade it. See how it goes. Collect the data. I think you're gonna maybe you'll be tickled a little bit. A little bit of tickling going on. You're still learning how to set up a spread right, and that can be an art form in itself. There's it's layers of abstraction stacked on top of layers of abstraction. So there's different types of spread too. I would personally just recommend picking one type and just learning that and honing in on how to select your contracts. The doctor says, I think I found my niche. Where's your nephew? With the press and cash secured puts. Absolutely. The press is gold, dude. That's why I was so excited when Bull started talking about it, when we were planning the Traders Paradise stuff. He ran me through what it was basically, and I was like, oh, that's institutional AF. I love it. And then last time when we were in Chicago, I pulled him aside and I kind of walked him through what I do to modify it a little bit more and just squeeze out a little extra profit on it. Because you can mix, right? You can make a hybrid press with the wheel, and it becomes disgusting after a while. But it's complicated, so I don't want anyone here to just jump into options and spreads and wheels and stuff. Build the foundation, right? Paper trade, practice. Don't just jump into any new thing blindly. Yeah, he's got his classes. That's today, right? Yeah, 1:30 Eastern. 3 o'clock Eastern. That's his spread trading live. So if you're in premium, you get to see that. He's going to be in the trading floor at 3 o'clock Eastern. So, yes. Breckle, if I can learn multi-leg options. Are you saying that you don't understand multi-leg options, or that you want to learn, or that you that you do understand them. Do you do spreads? Emmanuel Gibbons on X says, what do you think about NVTS? I like NVTS, only when there's volume. Semiconductor fella. So weekly chart, you can see we've already traded that range quite a bit. It's kind of heading back up into there, but there's also potential head and shoulders forming, blah, blah, blah. We don't really care too much about that. Looks like the last time we looked at this one was down here for that leg up. It's the same concept. We're just looking for areas of violence and displacement. Obviously, you've got one down here. You've got one transitory level here. Let me just mark that. And then we've got this guy right here. And you've got this guy up here. Just kind of drawing out the levels really fast, really loose, just kind of plotting them out. And then we'll go through and we'll pick. So right now, it looks like you're in the middle of a range. Not a whole lot we want to do in that case. So we can look for a retest and a break, taking an entry on the breakout, or we can look for a break up here and then catch a breakout there, or a retest and then a breakout and a retest. Or we could sell down to here, catch a breakout, catch a retest. But this is transitory, so you're not likely to get a catch there. So you'd have to wait to there and catch a break there. So the moral of the story here is that we're really just looking for breaks out of ranges that have shown clean historical violence, and then setting a nice tight defined risk. So what do you like about the company? I don't like the financials personally. I think they can be a little stronger, and I think they have a lot of internal obstacles myself. But I'm curious, what do you think about it? What put that stock on your radar? If you're still watching the stream on X. JWAG, 100% learn how to trade and understand stocks first. Then bull stuff is easier to get to grips with. Absolutely. That's not to say there's people that don't start with options and they do okay. But if you understand the underlying, you're going to have a much better time because you're going to be able to see things more clearly. You know, it's you got to be very cautious about things that you don't have a foundation. It's like building a house. Like anyone can nail something into a wall, you know, but building a foundation and making sure that you understand what's in the basement is important. Because when you fall through that floor, you need to know what you could potentially land on. Yeah, so it's not fun. Fergie, you and I talked about that in Chicago. I just transitioned from press to wheel, allowed assignment on T just in time for divvies. Oh, I love it. I love it. I love it. I love it. The Dr. Spider options, 8 different legs. We can, dude, you can have that. It is an amazing process once you figure out how to optimize that that credit piling, if you will. You know, it goes beyond like condors and butterflies. You just got to be careful is all. And by careful, I mean you have to be mechanical. Once you're mechanical, the risk is basically off the table for a lot of the stuff, and it's relatively self-working. It doesn't mean it's easy. It just means that the math works out either for a defined managed risk or a capped risk or a larger profit, as long as you set it up correctly. Breckle hasn't done naked options all year, selling calls or puts stress-free. I love it. That's what I want for you. As long as you've got the the coverage, that's a beautiful thing. Hell yeah. You're on the other side, so you got all the people that are buying your calls and puts getting burned. I love it. Breckle's the bad guy, guys. He's not a bad person. He's a bad guy, like Bowser said. I'm a bad guy now, too. Buy my stuff. All right, well. Did you sell me the 6710 SPY0 or SPX 0 day? I know it was you. It's got your initials on it. That's an important concept too. Is and this again just boils down to understanding volume. You know, you have to understand what moves the price, how float and shares and contracts actually work. Because if I buy a contract, it doesn't come from nowhere. Someone else out there has to write the contract, whether it's an algo, whether it's an institutional investor, someone like Ethan, for example, working at a firm, or if it's someone like Breckle that's just out there selling stuff. You know, someone has to create the contract. It is written. It is placed on the order chain. Someone has provided liquidity. There is another party that's going to provide an equal and opposite part to this transaction. It doesn't mean I'm going to sell it back to the same person when it's time to sell. It just means that they've provided it on this market that I can participate in. And in order for me to get it, I had to give them cash. And that means they had to receive cash in exchange for the risk they're taking by writing that contract. And that's where it gets, you kind of have to remind yourself of that every now and then and really bring yourself back to base when you're dealing with shares and contracts, because a lot of people just lose touch of that and they just see numbers and candles and they don't view it as participants, and you have to view it as participants. Sorry, my Discord text is like super small on the other screen. Yes, sir. I hate how Robinhood displays a covered call. Yeah, so it's going to show you negative because you're taking a debit, or you're taking a credit technically when you sold it, but you have a it'll show a negative return until it's locked in. That's on Home Depot. Very nice. Ooh, looks like the ORN's getting a little bit of a push there. I like it. I like it. I like it. What's SPY doing? Still just kind of hanging out. Let's move it a little higher, right? Just gradually higher. One thing I'm going to do is I'm going to mark the beginning of the trading session. So let me just draw that out as well. And then I'll mark the end of the trading session, which I don't want to be in at this at that point, obviously, but I want to at least have it marked out. And then I'm just going to come back up here to the 5 minute and we'll just watch this. And this is kind of the range for the day as far as the x-axis is concerned, or time. So we'll just keep an eye on that. Crispy. I have a few SMCI contracts up today for about 26%. I know people want to buy them from me, but nope, these things are worth more than that to me. There it is. So they're worth something, right? That means the other side has to pay a cost, and the value is something they decide. Just like when you pay the market, when you take a loss, you have to assign a value for that loss. Otherwise, it's a waste of money. So that's what the idea of free exchange is. So you've got something of value and you've valued it at a higher level than you're willing to sell it for in comparison to what it is right now. And the expected end result is that someone is willing to pay that future amount. And if the price continues to move up, it'll be worth that. And then you can sell it. One of you guys will be right. One of you guys will be wrong. That's how it works. It's a free and fair exchange. There's some rigging, which does come with the market and the mechanics behind it. But it's as fair as it can be in terms of what we see versus how we participate. You know, I was 39 to start, rolled it off to 2 now. Don't recommend, do not do what I do. Yeah. Freckle's what we call a wild card. And you already took profit on it today. Did that profit secure you a net profit overall? Or are you just kind of scaling out in pieces? There's Breckle right there. Not for this one, but nice still. Right, that's fair. How's your trading over the last 3 months? Are you net positive? She was a chunky return. That sounds like a really badly written romance. Anyway, we'll circle back to that at the end. Not yet, but on my way in due time. That's perfect. That's the right answer. On my way. That is always the answer for anyone that is not already net profitable. And even if you are net profitable, you can always be more efficient. I can be more efficient. You guys saw that spreadsheet. So what's stopping you? Just time? If it's just a factor of time, that's awesome. So it really likes this zone. I like seeing this. This is nice. This is delightful. This tells me exactly what I want to see. It tells me that the original thesis for the bearish side still has potential, but it's less likely. And it tells me that they are burning the calls. The call side is heavier, and they want to burn those premiums down so that they can acquire them all at cheaper prices and then release the price to the upside if that's what they want to do. And then they can cash in at a higher profit. So I'm okay. It's just a matter of efficiency. I'm not going to be adding any more to this, obviously, but we are in the zone that I like. We're coming up on the lunch hour in about 45 minutes. And also, let me check my calendar here. I've been on here for a while, but I want to make sure I can continue to hang out with you guys. So yeah, we'll hang out for a little bit. Brickle. This last month was my wildest return ever. Smoked my YOLO Bitcoin stuff. What do you mean? What do you mean YOLO Bitcoin stuff? What have you been doing? You been leveraging? Talk to me. Plan harder. Thanks, dude. Thank you. I'm glad you're here. I know we're sitting in like a losing SPX trade so far, but again, that risk had to be identified ahead of time. I definitely don't want anyone copying me today because this is not the day. You're in Bitcoin at 600. Jeez. You sure you don't mean SPY? I'm just kidding. Yeah. Bitcoin. All right. So what we are doing here is we are establishing another. Let me draw this out here, make it dark blue. So this is our transitory zone. It is catching the price. So right now it's a reversal. But once the price pushes out this right here, we should see our clean break of the orange line and then a clean run up to the yellow line for a new high if it wants to go that way. But it's good though, because this threshold is lowering now. So I'm okay with that. Crude Capital knows I'm a degen. I think we all know you're a degen at this point. I love it. As long as you're relatively safe. You know, don't hurt yourself. What a slow morning. Let me peek back over here. All right, so I'm going to leave this up in the background, but I'm going to just start looking around and seeing what else we get here. You guys, like, these are the top runners of the day, and they're bland, right? Like we got BQ, right? We already mapped that one out. Not trading it. We got a zone right here. It's kind of running into that. So that one's kind of tapped out at the moment until it pushes higher. EPW did push up, did show confirmation, but eventually hit the stop loss and didn't show us another confirmation to the upside. So that would have been one small loss. Wolf is just being Wolf. Not much we can do there. I don't really like looking at that one, especially with the catalysts. You know, this one here, we've got kind of a zone here. It's kind of reacting, but it's not really. I'd like to see another kind of a deeper push into this territory and then a strong reaction on that one. But the volume here is just crapped out. So it's just one of those days. Like, I'm okay just sitting there on SPX. None of these really have good value at the moment, except maybe BENF. Like, that seems to be the golden child for the day. An IBG maybe, but BENF is definitely the favored one. And it too it's kind of in a chop range, right? It's not really doing much. You know, we already got the levels all plotted out. It's already kind of respected those. It's catching and reversing, but it's forming lower highs. It's just one of those days. You know, if you're going to trade nice and tight, it's a gold mine. If you're looking for bigger moves and faster breakouts, you're going to kind of have to watch for a little bit. You're probably going to want to trade higher time frames for stuff like this, you know? So I'm going to switch back over to SPX. DraftKings. Let's take a look at DraftKings. So you're looking on the higher time frame or the lower time frame? That's messy, right? So let's draw a zone right here, just for proof of concept, because I haven't looked at this one. I'm just going to draw this box. I'm willing to bet if I go on the higher time frame here and I look back, I'm going to see some sort of displacement and some sort of consolidation inside this box, and then the displacement out of the box. So let me kick it up the daily time frame. We got a little bit of a reversal. Blah, blah, blah. I'm just looking for one specific type of zone, and I don't really see it on the time frame. We got this right here, you know, consolidation, then it released, but mostly it's transitory. You know, it's just the price passing through it. It's not really anything substantial just yet. Now, right below it, though, we do have a nice zone. And that zone has been much more heavily favored. So if I draw this out and I make it orange and I make this one yellow, we will have our setup. So you can see if I just look at the orange box, you can see that this is where the price is displaced from. Like it shows consolidation, drastic release. We see that a little bit more aggressively, some consolidation, drastic release. So it's kind of a little bit of an overlap there, but I feel like the orange box is going to have bigger value, right? So now we'd need to look for a setup within that box if we're trying to trade anything other than just the bounce. So we're kind of at the bottom of the yellow box right now. I'd probably look at like the 15-minute. We had a 5 candle, it broke and it failed and it pushed lower. Well, I guess it didn't break the low yet. So that's kind of a testament to the strength there. But again, I would just be looking for a bounce on this one personally, if anything. I don't know where my chart just went. And this is just a risk reward play, right? So you've got this big move to the downside. You've got, let's just draw a fib on that. You've got kind of a threshold here of that 25% pullback that we get 90% of the time, right? And that I'm going to make a big yellow line, make it fat. Actually, I'll make that green so it stands out a little more against that box. So now, right, we've got an opportunity here to use this yellow zone as pass-through, which means if we get a push down into the orange box, we can then trade a break of the orange box, provided we find one with small risk that breaks out of this zone. This would be our distribution gap, our profit potential zone. And then this kind of would be our take profit for most of the shares, just to lock it in and get a net profit. Then you've got all this area up here for potential runners if it wants to bounce. If we don't get that confirmation inside this box, like just coming out of that box right there, I personally wouldn't touch this one. It's a lot of strength to the downside. We really want to pick our shots and make sure that we're not just buying something that happens to be showing friction, because we want to look for a displacement, at least if we want to be safer. So I like it. It's just still cooking. I wouldn't call it ready just yet. The tips of the noodles are still hard. Freckle, no comment. Also, let me turn my camera off on this one just so that you guys can see the whole screen, because I always cover that up. And then I end up putting the price like way over here so I can see the future. And it just doesn't. You guys can't see the chart. So we'll just keep that off for now and we'll hang out. Been going almost, well, no, we've been streaming for a little more than 2 hours, which is fine. But we'll see. We'll see where the price wants to go on these. That's interesting. So the contract, the price went down on SPX on the shares, and the contract just went from 52 to 50. So somebody's buying calls at the ask on this one, at least a little bit. It's enough to move the mid just a smidge. So either that means that they're buying outside, so they're getting wider fills, which is very likely, or they're getting aggressive size, and then they're pulling the mid up. So we'll see what happens there. You get a five candle run on the 3 minute? Yeah, probably. And I'm sure we're going to get that a bunch today. You got a 5 candle in both directions, I'm sure, if we look at the right time frame. So, and again, you know, the price has already been down lower, right? So if there's any emotion here, just because the price was up here and now it's back down here, you know, the price was here, which is lower than here. The price was here, which is lower than here. The price was here, which is lower than here. The price was all the way down here, which is lower than here. So there shouldn't be any new emotions in this area. And if there are, that's a good opportunity to study yourself, because that's where those impulses come from. So we can study that. So is SPX just filling that gap all day? Yeah, it's being kept range bound until they can release it once they scoop up all the contracts. But they got to burn the contract values down so that they can buy them up in mass and then release the price. So a common tactic is they'll keep price range bound like this, and then they'll drive volume and they'll absorb, right? They'll put like a wall like right here or something, and they'll just absorb, and scoop up all those calls and kind of encourage more people to sell them. And then they'll release the price. And since they have all those calls, they'll release the price in whatever direction they kind of want it to go. In this case, it looks like it's to the upside so far. And then they'll make even more money on it. So right now they're just absorbing. And this is a zone recovery strategy. They're just increasing their position sizes by absorbing and controlling the price in both directions, which tells me there's at least one big algo, one institution, and then there's a bunch of smaller ones that are trading the distribution gaps. So my job is just to wait for the big one to win, to release the price specifically. So if enough smaller guys jump in, and the big guy says, okay, it's time to release the price, and by guy, I mean algo in most cases, they'll bring the price back up here. Like they might even wash sale to artificially drive the price up. They'll let the price stay up here for a second. They'll do a little volume threshold test, and then they'll release the price if it's strong enough, because the little guy's volume and interest will push the price up to wherever they need it to go and over this high. So, but they're going to keep absorbing those contracts until that happens. Does that make sense? All right, got a solid 1 on that. Okay. So yeah, and on days where volume contracts are, you know, over popular because we've got like a looming government shutdown, which again is just a sentiment play. It doesn't actually tend to impact the market negatively, especially on day one, right? So it's already kind of factored in. You know, when we've got that though, there's a lot of participation on the options chain, and they're just going to exploit that. That's all. Contracts are overinflated, they're going to deflate them, and then they're going to amass them, and then they're going to release the price in that direction, and then they'll reinflate, and then they'll sell, and then they'll deflate completely. Now, if it goes to the downside, they have the same strategy in place, and that's the beautiful part about zone recovery, is they make profit in both directions after it's released. The only time they lose money in zone recovery is if it stays in the range. So unless a bigger, badder algo wants to come along and suppress that breakout, the big guy that's doing this, or the big collection of guys, I should say, they're going to make money. It's just a numbers game at that point. And here, I'll walk you guys through it, because I feel like this is a valuable thing to know. Just find a chart that I haven't scribbled all over like a toddler. All right. All right. So we got a blank. You know what? Let me just screenshot this, and then we'll draw on it like John Madden. Okay, we'll do that. Then I'll keep this up in the background. I'll just put this right at the edge here so we can still see it. And then I will, I guess I'll make it like this. Yes, like that. Okay. All right. So let's say we want to make a bunch of money. We're an algo. How the hell are we going to do that? Right. First, we establish a range. Okay. And that's just, you know, price comes in, bounces around, blah, 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 blah. Sometimes we let it go a little bit out. Sometimes we don't. And then we want it to do something like that. Or we want it to do something like that. Right? So right now we're in this part. This is where we're at today, right now. And the reason for this is because this x-axis has a decay factor. It decays the value of these contracts, and the IV fall off also is impacted. The value of the contracts decreases over time with a loss of enthusiasm and potential time remaining. So if I'm an institution and I know that this is an environment that I want to create, I'm going to ask my boss who told me to do this, like, why the hell am I doing this? And then they're like, I'm glad you asked. So let's change the color here. All right. So if I see the price going up and I want to see a reversal, right? And you can, like, this is where just high time frame analysis comes in. You can anticipate a reversal. You can gauge a general sentiment just using that technical analysis that people love. And this is part of that playbook that they give to YouTube gurus that sometimes works, and they see the confirmation bias. It's a bucket shop approach, and I'll walk through that after. But let's say we want to look for a reversal in this case, right? So we got price coming into a range that we want to establish. It's a historical range that we're familiar with. We've got our algo trained on it and all that good stuff. And price goes up, 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 up. I want to take a position right here, okay? And I want to acquire more every time it comes back to test this zone because I want to absorb the volume for the move to the upside. Does that make sense? I'm just trading a range, knowing that things range like 70 to 80% of the time, and they displace like 15 to 20% of the time. I can make a ton of money on that. Or I guess 85%. I got my ratio mixed up. Just scalping. Like, you add a piece here, you add a bigger piece here, right? And then you sell that bigger piece here and you keep the small piece there. And that's it. That's all we do. And that small piece is only held for a break in that direction in case it happens early. So there's still a clean strategy there, right? We can always make money to the upside if we're an institutional trader just by buying a small piece here, buying a bigger piece here, locking in that bigger piece to guarantee net profitability, keeping the smaller piece for a potential run, and that's it, right? Clean run, clean strategy. I love it. That's what we all should be doing as traders, in my opinion. But it's very difficult to execute when you're a new trader and not a computer, right? And then we got to account for the downside, right? And it's not so much that we just want to put a stop loss in here, right? Because we're acquiring more and more shares. We need to offset that risk so we don't take a loss. So instead of just setting stop losses, right? Because say this is 1 unit, this is 2 units, this is 4 units, this is 8 units, this is a huge amount, this is 16 units. Let's say we want to martingale this, which they don't actually do. They just, it's a ratio, but not a martingale. But by the time we get here, if we took a loss, that would be pretty substantial and our boss won't be happy. So we need to find a way to offset that loss, right? So instead, what we can do is we can say, okay, well, we can also incorporate trading the downside here. Okay, so I want to make money doing that. So when the price comes up here, I also want to take out a short position for the move to the downside. And I can run the same exact approach to the downside, meaning that I buy a small piece here, or short sell a small piece here, then a bigger piece here. Then I want to cash out on that bigger piece here to roll, to snowball those profits. And then I want to keep the smaller piece for a premature break to the downside, right? And then whichever way it goes, it's going to go disproportionately, it's going to go over a disproportionately larger range than this range. So the winner gets the net profit and we walk away with a profit, right? If we're trading the actual breakout. So then I can add this to every single time that comes back here and shows rejection off the zone. I can absorb all these shares. I'm big enough. But rather than setting a stop loss here in case we get that breakout, I want to counteract that with the bullish trades, right? Because again, I've got a bi-directional strategy here. The only time I lose money is if I keep acquiring shares in both directions and then I eventually just lose capital. Like I just don't have enough to keep buying and then the price just stays stagnant. And in that case, I can kind of break even because I've got positive shares and negative shares, but I'm going to make sure that I'm consistently locking those secondary pieces of the positions all along the way because that increases and offsets my loss just by doing that. Does that make sense? So I'm just skimming those ranges over and over and locking those in and letting smaller pieces ride. And this is sometimes done across multiple accounts. Sometimes it's done across the same accounts. But that's how they skim. And that's where the high frequency traders come in. They just buy and sell really fast along these little legs and they just constantly rake in money. It's not huge amounts, but it adds up. Okay. So then let's assume that we're amassing shares in both directions here and we've got a range. I'm just going to erase all this so we can just kind of simplify it. Can't draw, can't erase. All right. So let's now say we've got our range Okay, we've got our accumulation range, or our zone that we're doing a ZR on. And then we've also got our breakout range, right? And that goes in both directions. And that's our threshold to really commit on the trade. Okay, and then this has a finite size. Okay, so now I need some multiple of that size for a profit ratio. Okay, and then that is how we establish, that is how we establish profit zones before using that approach. So now, if I come in here and I say, all right, I want to do this. I want to say the price has come in, it's doing its thing, I'm acquiring shares, blah, 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 right? And I want to run it up to here. Okay, I'm going to sell, or I'm going to close out the short position for a loss. It's going to be a loss about yay big. Okay, it's finite. And the long position that I've taken is going to have a much bigger potential, maybe 3 to 5x, right? Now I can go to my boss and he's like, what the hell, you took a loss? I'm like, yeah, but I also took a 3 or 5 times or 10 times, whatever the size of the range is, profit, and my boss will be happy. So that is zone recovery in a nutshell. And it all boils down to having enough capital. And that's something that retail traders don't typically have, especially on higher cost things like SPX. So we don't need to do this whole thing if we want to make profit. All we need to do is replace the short stuff with a stop loss, because we're still going to take a loss, right? We both take losses. You and the institutional traders all take losses. The trick is that their losses are offset through multiple means so that their profits are just much bigger and much more frequent and consistent than yours are, because you're a human and you don't have as much capital and you don't have the speed of execution that they have, and as well as the toolkit that they have. And that's not a Bloomberg terminal or anything like that. They just have more tactics. They have more strategies that are proprietary and you just don't see them, right? So just a one or two, does a strategy like this make sense? Just on a logical scale? Like, is this something that you could see an institution using to make money? Fergie says 1. Charlie says 1. Yojo says 1. So it's kind of a common sense thing, right? Like, they're just hedging against the loss that they're going to take inevitably. Anytime you take out a bidirectional trade, you're going to take a loss. Your profit just has to be bigger. And that's all a spread is, if you really think about it. One of your contracts loses, one of your contract wins. That's it, but it offsets, and that's how you make your money on spreads. So when it comes to equity trading and specifically zone trading, you know, these algos set up all the time, and you can see them on the order book plain as day. They're just big symmetrical walls that sometimes are offset, sometimes they're even. It just depends on where they are in relation to the bid and the ask. But you know, the bid and the ask are all along this chain. The bid moves up, the ask moves down, and vice versa. Well, it's moving in between these ranges. And then the only thing that changes is this whole bracket moves up and down through all these charts. And that's all we see when this specific pattern is not apparent. Okay, so think of every bid and ask block, every cluster of bid and ask, or every candle, or every 2-cent range as a mini zone recovery. And you can have a much better time in the market by just picking some levels that make sense. I can't draw that. I can't erase that one. So is there anything inherently wrong with just grabbing a range where the price has done something and just trading a break to the upside, knowing that you can do it repeatedly? Right? All you're doing is you're playing with the absence of that short, the short roll, right? That's all you're missing in that equation. Okay. So now if we were to take this and say, okay, I'm going to enter here. Sorry, I had to change my lines there. And then I'm going to stop out. Oops, that's too far down. And I'm going to stop out right here. Okay. Is there anything wrong with that approach? I wouldn't say so. And that's just the basic concept of risk reward. You're taking losses. Yes, it's going to happen. It's absolutely going to happen. You've got the price moving in the direction that's going to make you money. It continues to do so until it hits a point where you can lock that money in, or it's going to stop doing what's going to make you money, and it's going to go the other direction, and you're going to take a loss inevitably on some of those occasions. And your job is just to make those small and controlled, because you're not hedging with shorts, right? You're not trading the downside in those cases, because you're just trading the upside with disproportionate risk reward ratio. So in this case, we've got a finite number of outcomes here, and it's pretty cool because we don't have to worry too much about being right all the time once we figure out that that's all trading really is at the end of it. It's just a bunch of little moves up and down. So I'm going to take a step further. Is there anything really stopping you from having a 1 cent stop loss ever? And I know that the people that have been on my streams before, you guys have kind of sat through it, so you guys know the only real trade-off there is going to be your frequency in loss in exchange for a minimized loss, right? So if you have 20 1 cent losses in a row and 1 37-cent win in a row, you're net positive. So it's really not that hard to get a 37-cent profit, but it's very difficult to accept a 37-cent profit, and it's very difficult to accept a 1 cent stop loss. So we choose the size of what we endure right here, and we choose the size of what we endure right here. And that difference, right? The gap difference between that and that all boils down to one thing. I can't draw arrows to save my life. Hang on. Bear with me, guys. It's my first day. The rotation stuff messed up the alignment in my brain. And I'm just going to write this word. And I spaced it perfectly. It's psychology. That is the only thing that makes the difference there between someone who is willing to accept a 1 cent loss and someone who is comfortable accepting a larger than 1 cent loss. So we are all on a gradient for risk tolerance, and that risk tolerance has to match the reward tolerance if you want to be net profitable long term. And I say this with a SPX 0 day that's 50% down, so ignore that part because you guys have already seen me make profits. But this is what it boils down to. It's all psychology. And if you can't focus on this and you can't lock this down, you'll never be able to accomplish this. I just walked you through exactly how institutions do this with one of their strategies. It's a very common strategy. It's on almost every stock that has volume, high volume. It's one that I exploit in the mornings when I trade those low float poppers. It's zone recovery. It's just chain fills that push it beyond a threshold, and they drag the price up, and then that carries forward, right? I walked you through how they trade both directions to offset their losses and get a disproportionate larger profit than loss ratio, and how you can only participate in most cases if you're on a cash account to the upside. So you can still do the same, you can still run the same machine, but you're just missing some parts, right? So your profits will be a little bit less. But now within this, is there anything stopping you from adding a small piece here and then that secondary buy there, and then selling that secondary on a shorter range? Is that something we can do today? I'm making this like messy. Sorry. And I'll redraw this here specifically. Does this make sense though? I'm going to erase all that actually, and I'll just redo it. Who here averages up on successful positions ever? Is that something you guys are practiced with? Charlie says 2. Okay. And there's no wrong answer. I'm just curious. So let me draw my range. Okay. And then I want to draw another level up here. Okay. And then I want to put my, well, we'll know that our stop loss is down here. I don't want to keep redrawing a bunch of stuff. But you guys can generally sense that There's a profitable scenario. Sorry, I got to move that up here. And then there's a losing scenario. Okay. But within that profitable scenario, there are opportunities to make it even more profitable because your losses are going to be the same size. Okay. Now, if we place a buy here, and then we place that sell here, we've got a distance the price must cover in order to get to the profitable outcome where we can lock it in and make sure it's ours, right? At any point, doesn't matter if it goes all the way up to here, falls short, comes back down, there's only going to be two outcomes, right? It's either going to be this profit or that loss, okay? So what we need to do is find a way to increase the profits when they happen without increasing the risk unnecessarily, right? So if I add another buy here with the intent to sell the second part here over a shorter range and guarantee a bigger profit, that does introduce a specific risk. And that risk is that the risk size is larger, and that second buy must also cover a greater distance and result in a loss. So you're going to immediately think of this and be like, well, that's a losing scenario, right? Because if you take, let's say you take 3 trades, you take one of these, right? Let me just draw these out. Okay, so let's say you take this one. Actually, I'll do this cleaner. We'll just draw through it. All right, so there's the first one. There's the second one, and there's the third one. Okay, so 3 separate trade elements. Each one has 2 potential outcomes initially. Oh, I got to change the color of that one. Sorry. It's my first day, guys. So back off. All right. This makes sense, right? So if you're just position trading, meaning you buy here, sell here, or sell here, same end result, you're still exiting. You're just either locking in a small loss or a larger profit 3 times in a row. Okay, pretty straightforward, pretty easy. So if I place my initial buy here, I can place a sell here on all 3 of those trades. Okay, that's pretty straightforward. And then I have potential here for a loss on that first buy. So 1 entry, 2 exit conditions, or 1 fixed position size. Now, if I change the color of this, maybe we'll do like this this beige color, right? Now, if I place a second buy somewhere along here, I've got 2 outcomes, and that can either be a greater distance traveled for a loss or a shorter distance traveled than the initial buy for a profit, right? So that tells me there's something I need to do differently here, because if I were to do this 3 times in a row and each of those would come into a loss, I'd be having the first buy turn into a loss at the fixed size, which is healthy, then a larger position turn to a larger loss because it's traveling over a greater range. And I can't do that a whole bunch of times because that's going to outperform these profitable outcomes unless I hit more of those than I lose. Does that make sense? So this system has a flaw. And it's up to me to fix that flaw before I start using it in real money. And this is where I want you guys to practice this stuff. Scrutinize everything I say. I don't care. That's my job. I want you guys to poke holes and stuff because I don't want you falling into systems like this without knowing how to properly mitigate them. So when it's time to place the second buy, I have to identify the risks. So what are the risks here, right? A, I'm increasing position size. B, I'm increasing the risk range. And those are 2 unhealthy things if they both go in the same direction and that direction is against us. If they go in opposite directions, that's great. I want small positions exposed to bigger ranges and vice versa. I want big positions exposed to small ranges, and I want them to go in the direction that I want them to go. So I know this ratio is messed up. Does that make sense so far? Is everybody like following along? So how the hell do I fix that? If I still want to take advantage of the system, I just got to fix it. So I still want to buy here and sell here. Okay. But I have to stick true to my law of if I have a bigger position, I need it to cover a shorter distance, right? So rather than coming all the way down here to the stop loss and accepting that, why don't I just put my stop loss for the second buy right here below my break even? Does that make sense? Because then I'm obeying the law, and if those go up instead, I get to have my cake and I eat it too. Okay, so Charlie and Yojo immediately hit 1. That's awesome. This is what institutions do. They literally sit around and think of strategies that they can use: position management, risk range sizes, portfolio allocation, instrument blends. There's all kinds of factors that they lay out on a table, theoretically, and they come up with strategies like this, and then they implement them and they test them rigorously with simulations until they find the ones that are the most efficient. And that's what they use. That's how proprietary strategies are developed. And now that I know how an algo actually trades this stuff, I can do this for myself. So next time I'm trading a momentum breakout, and you guys have seen me do this, if I want to trade, let's say, let's pop over to BENF. I know SPX is kind of moving a little bit right now, but let's pop over here. All right, let me, I'm going to leave these ranges here, but let's say that I want to push for continuation, right? Let's say I've got a range right here. I want to see a breakout, so I'll place a small buy right here, or maybe a little closer, right? Because we want to get it right there. Okay, so I'd be in right now, and now I want to see it break over, let's say, this little wick right here. So then I would add another small position right here, or a bigger position, I guess. I'll draw 2 lines, and then my average should be somewhere around here, my break even, right? So now, if I want to, if and only if it pops up here, I still have my initial stop loss here on that first share if I want to. But up here, maybe I want to buy 2 shares or 200 shares if it's a sub-dollar stock. But if I get filled here, I need to protect these 2 units above all else, because they're the bigger ones, and that's going to effectively triple the size of my position. And I don't want that if it's going to go against me. And I certainly don't want it to come all the way down here to my stop loss. Okay. I only want that to come down to about here, wherever my average is. And then I would cut that there and keep these initial shares, because that's what's going to make me the easy money, right? On a lesser position. So let's see. Let's just walk through that really quick, and maybe we'll see this in real time. So in this case, we would have been in for our initial shares, and we would have a stop loss right here just for funsies. And again, this is a terrible example because it's like a low float garbage runner, but bear with me on this. So now my target, assuming we took it in a healthy neighborhood, this is not a healthy neighborhood, so I doubt this is going to go well. But assume that it is. Our target needs to then be some ratio of this range, right? So if I've got a range of, let's say 3 cents, up here it should be at least 6 cents. This right here is where I would look to sell, those yellow shares, right? The bigger amount. That's a 1 to 2, and that's a pretty high target. Normally that would be lower. And then this little guy right here would probably be like a 1 to 3 ratio. So I'm just going to draw it up here. Okay. And of course, if there's any like levels of resistance that get in the way, we kind of have to factor that in and all that good stuff. But so right here, we would have been filled on that secondary buy, and we would have our stop loss somewhere down here, ideally like right around the initial buy. And that risks more exposure, but it's over a shorter range. So we can adopt that. We can absorb it a lot easier. And that's it. So let me just erase all these extra lines here. So we would have just stopped it on that second buy, and we can always recommit. We can always add more to the position if we want to, as long as it stays above our stop loss and it keeps hitting this threshold. So in this case, if this does move down and hit stop loss, we would still take a loss. We can't avoid that. But you're taking the initial loss on a small buy, and then you're taking a much smaller loss on a bigger buy. So yes, your loss does get bigger, your position does get bigger in terms of your red, but you're limiting the amount that draws down overall. So you're helping yourself minimize the loss while also providing healthy risk exposure in case it goes to the upside, because if it goes to the upside, that double size also works in your favor twice as much. And that really speeds up the growth of a portfolio once you figure out how to scale in and out over those tighter ranges. Now, again, this is not a healthy neighborhood. I'm just kind of picking this one because it happens to be, getting volume. So take that with a grain of salt. So right now we'd still have that initial buy, and we would have taken a small loss on a second buy, and we have the opportunity to recommit and to buy another segment So we'll see if that gets filled and pushes. And let me just draw horizontal lines here so we can also see kind of where those lines are. So I'm just going to kind of draw some yellow lines for that one. And then for this one here, I'm just going to draw like a green line here, and I'm just going to erase this guy because it's the same thing. It's just a target. All right. Okay. Did I have to do any analysis at all on this? No. So in this case, we would have added our second buy. And if it continues to push, we would lock that second buy. So we reduce the position size. And then if that initial share or initial position wants to continue up to that 1 to 3 target, we have it. But we've also layered in an extra set of profits in theory, right? If that hits that target, just by doing something simple like placing a second buy and a second sell. So those second shares would have received an extra 6% profit if this goes up and hits that target. Now, again, I'm not measuring this chart the right way. I just kind of grabbed some random candles here, but you guys can see the concept, hopefully. All right. Does anybody have any questions about that? Like, does that make sense? And does it seem like it's something that we can, start to incorporate? Because guess what we've done now? Because we took a second buy and because we took a second sell, we've guaranteed a net profit by managing the position size that way. So even if this first share comes all the way back down and hits stop loss, we'll still be net profitable. And there's a lot of value in that, because how many times does your thing move up and then come back down and hit stop loss? Like, there's nothing wrong with layering in second pieces, as long as you track where that original stop loss is. You can also just move that up if you want. I mean, this is decent enough potential. When is good enough, good enough. But that initial share now has zero stress attached to it because we have a net profit overall. So it's a lot easier to accept the profit that happens or the stop loss that happens, because we don't have to be right at this point, because we've already been right. So it's a major psychological boost to just manage a position more mechanically than it is to try to just place a buy and hope you're right most of the time. Even if you are right most of the time, it's still going to be stressful. So hopefully that makes sense. I got to switch back over to SPX, so we're getting some push and pull on it there. But does that concept make sense? I hope, to more than Charlie and Yojo and Fergie. Chris M does it with his long-term investments. Fergie averages up on long hold positions almost every green day. That's awesome. Now, are you scaling out of those as well? Well, they're long holds, so you're probably not if you're doing it for dividends. But now that is a strategy that I literally just walked you guys through. The zone recovery algos do it, and you can see it on the order book. I'll walk you guys through that tomorrow morning in premium. And then that's not a sales pitch. That's where I'm streaming. Oh no, Lee's streaming tomorrow. Friday morning in premium. I literally just walked you guys through algos, how they work, and then we can take pieces of that and incorporate it into our portfolio pretty effectively. It's just, we got to get over that psychological hurdle of, using too much of our money too fast, and then you have smaller positions that can readily outperform bigger positions if you just let them breathe. And we don't always want them to breathe super far on the upside or downside, I'm sorry. But, it just takes practice. That's all. Fergie says, nope, not unless I move the position to a different divvy ticker. That's fair. So you're trailing the average up then. Sorry, top, let me read that. So you take here your extra 2 added shares out and leave a first buy and a stop loss at entry when you added the 2. Yeah, pretty much. So if we look at the ENF, right, we just walked through it chronologically. We would have placed our initial buy here, right? And that's just a simple color change for continuation. Not a lot of complicated analysis there. So let's assume it's one share, right? Let's just use single shares. So one share here with a stop loss here below the recent low. And then as it continues to push, we would have layered in 2 more shares for a total of 3. And then we would sell 2 of the 3 shares right up here just to guarantee a net profit overall. And in one attempt, we did try, and it failed. It came down and hit the stop loss, which is higher. The stop loss is like right below the initial share, because we don't want that bigger position to come all the way down here to the stop loss. We just want to cut the bulk of it tighter, right? So if we really, if we eliminate everything on this chart, okay, except that second buy, all right, the entry would be here, the stop loss would be here, the stop loss would be right below this guy. So I'm just going to move that down just a little bit. Bloop. So that gives us a risk reward of that to roughly that on that second piece of the trade. Does that make sense? So the original one would have been like here, or I guess the entry would have been like down here, right? And then the reward on that initial trade, oops, I got to draw this up here, right? So we're letting a small position run over a larger range, okay? And then we're adding in a second position, and we're keeping that over a shorter range, okay? And that's the name of the game, and that's how the algos do it. So if we want to add up and scale in, we can. We just got to be very careful, because that range has to be inversely proportional to your position size. Otherwise, you're too weighted in one direction, then one direction loses your money. So we got to be careful. Is there a round 2? Yeah, I can imagine. A lot of those little floats are probably going to get some attention. That's nice. I like it. I like it. I got to switch back to SPX though. I'm just going to keep an eye on that one because it's getting it's just been in this range all day, right? And we have to accept that. Now we're in the lunch hour. There's going to be fewer eyes on the chart, you know, and that's sometimes is when they do the sucker punch and drive it out of the range. But for right now, we're still in the range, and we can't let the what if kind of drive us. So I'm sure my contract is probably toasted at this point, and that's okay. I don't expect too much buy up unless we get up here. You know, we got to have a much sooner rally than the end of the day, right? Up or down. But again, that risk is accepted before I place a single order. Same with equity stuff. If I'm going to take drawdown on equity, I accept it ahead of time, and I have to be okay with it. Oh, sorry, let me catch up on the chat here. Chris M, not scaling out. Started the portfolio in March. Okay, that's good. So you're also just kind of trailing up the growth by moving your average up. Good stuff. You're like selectively DCAing in. Buying every Monday. Okay. Yeah. So you're just getting little pieces on a scheduled basis. That's more investing. And that's what I like to see also. If it's quality, it's got to be a quality company or quality ETF. We don't just want to buy stuff to have it. We want to buy stuff that has, oh yeah, no, you're killing it, man. I know your portfolio. I like your portfolio. I'm jealous. You have a hell of a ratio, and you're a lot earlier, I think, in your trading journey than I was when I started investing. So I think you're off to a great start. So just keep that going, man. So also let me just check over here on ViewIRN. So this is one that I would consider adding to. So like, for example, I like it here. I've got one share. It's a $22 share on a $50 account, which is now down significantly because of SPX, and that's okay. If I wanted to average up on this one, I would wait until it's up and I would place a second buy. And I would put my stop loss on that second buy relatively nearby. I wouldn't let it come all the way down here and then try to build a position down, because at that point I'm too top heavy. And if I did place a second buy, I would place a second sell long before this target, just to guarantee a net profit, just to lock it in. And that's how you make your profits on those bigger moves, is you want to manage the position aggressively in the direction that it's traveling. And that aggression needs to turn into cut if it goes against you. Like, that's it. So if I just want to trade this one stock with just this one share, I've got a defined cut point. I've got an average down point if I want to. I've got a target where I can cut it either way. I choose whether or not I add or remove exposure to this position, and that is the only thing I can ever choose. I don't choose whether or not it goes up or down. I know they have earnings on October 9th, and that's cool and all that. We went through that in a deep dive on Lifetime yesterday. But my only choices are to add or remove. I just add or subtract. That's it. And depending on where and when I add or subtract, that's what tells me whether or not I'm a successful trader long-term and whether or not I make money or lose money. So I have to make my decisions based on what makes me money overall. And to do that, I'm just going to copy the algos. I'm not going to do what someone on YouTube says they do. I'm going to do what they actually do and what I can see. I can articulate this. I can see where the volume is. I can watch the order book. I can assess the time and sales as it comes in. I can learn about institutional mechanisms, and I can apply those to scrutiny, or I can apply scrutiny to those. I can criticize it. I can collect the data. I can verify my thesis, and I've been doing that for 15 years. So I've got a pretty good sense of when the market is doing certain things, and if there's ever something I encounter that doesn't make sense, I study it. But in the concept of just making money, all I need is this, and I don't even need this part, right? This is just extra. You know, I don't have to do all that. I don't have to do all that extra stuff. Wow. That line's staying there. I don't care. I hate this drawing tool. Do I find the moving average helpful at all? Sure. If it helps you understand the price action, absolutely. All technical analysis does is tell us when to cut our exposure. That's all it does. It helps us identify potential so that we know when and where to cut our exposure at any given time. So if I were to apply the moving average to this stock right now, the 2-minute, I already have it on the thing, the 2-minute SPX chart. Okay. Is there any real advantage to having this line on the chart? Absolutely not. It doesn't influence the price. It doesn't move the price up or down. Price doesn't automatically respect moving averages. Moving averages are a reflection of an average of participation over time. They're a visual representation of a cluster. And when that cluster aligns with an area of structure, yeah, you've got high potential, but it's not because the line happens to be there. It's because that's reflecting what you're seeing. It's a consolidation of participation. And that's why there's no better analysis. It's not indicators versus structure. It's not volume versus candles. Well, none of that really matters. It's just how much exposure am I willing to endure in either direction, and what compels me to get in and out. So there's going to be, there's going to be little moves in price. Like right here, we can watch EPOW. I see zone recovery algo, so I'm going to draw the levels. I have a 130 and a 133 and a 150 level. So let's draw those, and we can make them big, fat, and orange. And we can assess what happens at 133 and 150. And this is one that Lee had on his watch list. Right? And remember, the tendency of this is probably going to be to bounce between 133 and 150 for now, unless the volume up here is strong enough or the volume down here is strong enough. I'm going to erase Lee's lines. Sorry, Lee. No offense, but I'm just trying to demonstrate a concept here. And I'm going to erase that vertical line as well, so it's nice and clean. Now, beyond the zone recovery threshold, I also have a 155 and a 158 and 160 wall. So let's see what those are for. 155, 158, and 160. Okay, who can tell me what those are? It's a 2-word answer. I'll tell you what the answer is, right? Because remember, what happens when we leave a zone recovery range? Let me move this over here. Right? If we're ping-ponging around inside this threshold, what happens up here? Let me draw these arrows as well. So let's say that we've got our, our position, right? We've got a threshold test right here. We've determined it's strong enough for a breakout. Price breaks out. What do you think the algos are going to do, knowing that they've got a wall here, here, and here? Those are chain fills, right? In theory, if the volume is strong enough, these are those secondary ads that we see right here. So we're also going to see some sells up higher. Obviously, I can't really draw too much higher on the canvas here. But those are secondary ads, tertiary ads, and those are going to, in theory, those should lead to bigger moves. And then we've got corresponding walls up here in the 160s and 170s. So those should be there should be a nice little gap here between 160 and 170. So let's draw it out. 160, 170. And then if I zoom out at that range, guess what I see? I see clustering and displacement. I see a catch and a transitory zone. I see a catch and an attempted reversal, and it turned into a transitory zone. I've got another area where price launches from. Right? So the algos view the market in terms of compression and release, right? So this zone right here, the zone recovery that it's running, this is the compression. This is where they accumulate. This is where they absorb. This is where they control the price. We're in a big catch right now. We're in a catcher's mitt, right? So in theory, the prices come down here, it gets caught, it gets sent back. The price comes down here, it gets caught, it gets sent back. Eventually it'll fail. Eventually it'll be easier to catch it and turn the glove over and drop the ball, right? It'll be more profitable in that direction because of zone recovery and how that works. And I'm willing to bet there's another set of walls down here somewhere. And we got smaller walls, 112, 110, $1. So let's draw them out. 112, 110, and roughly, I'm just going to draw them really quickly. Right? So price is going to break in theory. Price should break up to there. I'm going to make that fatter. Or in theory, the price should break down to here. Because in that case, it should be directional, it should be strong, and we shouldn't see a whole bunch of friction. So is there any value that we can't get from this other than to maybe trade the range, right? We've got a range here. We can trade. Right? We've got opportunities here. We just have to be very careful about how we take advantage of them. Does that make sense? Now, this is an instance of the order book, so we have to be mindful of that as well. Some of these walls are temporarily placed to manipulate, and they will be pulled, they'll be moved around, but this range correlates. There's previous historical price action, which confirms that there is a catch and release nature of this area. So I want to be part of that. So I can't trade on, well, I guess I could on this account and trade like one share or something that comes back down, but we need volume, right? We need it to not be sitting in the middle. Okay. If and only if we want to trade the range, we need to trade the range. If we want to trade the breakout, we need to trade the breakout. And we can't trade the breakout if we're buying it up here or down here or down here and then, you know, selling it, you know, anywhere other than where we should be selling it. So, you know, it depends on what your specific approach is. It doesn't mean that the price is absolutely going to go up and it's going to chain fill and all that stuff. That's the setup. And that's what the institutions want the price to do. Everyone other than the ones that set those walls. The one that sets the wall doesn't want that to happen because then they're exit liquidity unless someone else comes in and picks it up. But this is potential. This is just the opportunity to trade that range. And And if you want to trade the breakout of the range, you can do that as well. It's just a different approach. One of those two things will happen. You've also got a nice choppy range right here just outside that box, heading up into those chain fills. But if you don't have any plan whatsoever and you're just buying stuff because you see a green candle or because you see a red candle, even worse, because then the price isn't going the direction it's going to make you money, what kind of day are you going to have? Right? I'd rather have a plan here. I'd rather wait for the price to come here so I can place a buy. And if I'm wrong, I have defined risk. I have a disproportionately larger profit, and I have an opportunity to place a secondary ad with an even tighter range in both directions if I want to compound that position. Every now and then, they're going to work out. Every now and then, they're going to stop out. You can't control that. Sorry, let me catch up on the chat. You know how I get sometimes, guys. Yojo, why wouldn't you wait until price is outside box either side? Yeah, I just answered that. So right now and then I fall apart. Oh, songs. It hurts. Turn around, Charlie. But that's really all the market is. It's just a series of ranges that get broken and maintained. And you could just pick a random level and have the same end result in a lot of cases. And I'm not saying that to say technical analysis doesn't matter, because it does, but people misuse it. They use it to try to predict, and they use it to guess, and they use it to feel good about their decisions. And usually what happens is they feel bad about the end result. So to stop all that, we need to focus on the end result and controlling it, because that's where we can find the achievement in trading, and that is minimizing those losses as much as possible. It doesn't matter what strategy you use or how much or how little you know. If you can make your losses small and consistent, those profits should outperform those pretty easily, or pretty steadily, I should say. So we'll keep an eye on that one. We'll come back to it. But this is all SPX is doing. It's just bouncing back and forth. There hasn't been any new information here. It hasn't displaced yet. It's just kind of chilling. So if there's new emotions and it's not tied to like IV and theta and stuff, then, keep an eye on that. Study it. Are you becoming impatient? Are you frustrated? Is it money that you need to pay your bills and you put it in SPX hoping to make it big? Because those are deviations of higher steps in your trading plan. And that should all be resolved before you get into any risk exposure. And that's why we got to have a plan. So, sorry, my mouth is getting dry. It's delicious. So hopefully that all makes sense. I know this has been a kind of a longer stream, and I just wanted to kind of hang out with you guys. And I'm gonna, as long as I can. Yeah, I'll keep hanging out for a little while. But hopefully this shows you guys, like, this is, sometimes losses happen, sometimes they're bigger, and that's okay. It's all part of trading. It's all in your brain. And that doesn't mean blame yourself and beat yourself up when things don't go straight to your expected outcome. It means that everything you have is in there, or everything you need is in your brain. It's just a matter of plucking the right strings, the right cobwebs, and getting stuff to line up the right way so you can put things in perspective. I'd say, well, if I'm frustrated or I'm angry about big losses, the best thing that you can do is just stop taking big losses. The only way you're going to take big losses is either through positions, big position sizes, or big exposure ranges. And that's it. Those are the only two ways that you can take big losses, unless something delists and you're just trading absolute trash and it gets OTC and all that. But you guys get the concept. If you cut one or both of those things out of your trading, you won't have big losses, as far as I'm aware. And you can still have big profits, because again, you can trade big positions or big ranges and get bigger profits, but it has to be proportional. It has to be proportional, and it has to be deliberate. And once you figure that out, you get to stand up and stop drowning in that shallow water, and you'll have a much better time in the market. Even if you stumble every now and then and you just take a big loss on a big position that went too far down, you couldn't hit the stop loss in time, whatever, that you're human. You got to show yourself some compassion about that. But if you try and you have a plan and you have a specific checklist and not just a list of concepts, it is something I have every confidence each of you can achieve at some point. Yeah, it's kind of going a little bit. It's still in the range though, so I don't want to get my hopes up. Hope should not be part of this. Abandon all hope. There's potential. It's definitely showing some strength here, but if I look at a higher time frame here, this would be a 3-bar. So in theory, we should be able to, we should see something. What's that? 1240. We should see something kind of equal size. So what's that? 1240. Let me just move this up here. Yeah, I mean, if that turns into a 3-bar, we're looking at 66, 66, 69, 66, 70. Again, it's got to break out of this box and it's got to get over this orange line. And if it's going to go up to here, it will do that. Otherwise, it won't. Right? Kind of a common sense approach there. And that's kind of all I need. Yeah, it's like a BENF. It's a beautiful, beautiful move. It's good stuff. I can't trade this one. It's it would cost $80, and I don't have that on this account. But you guys get it. And then if we tune back here, right? This whole area up here, oops, this is all extra. Okay, this down here is all extra too. But most people are more comfortable or more familiar with this extra than they are with this, because this is the unknown. They're not used to it. It's stressful, so we avoid it. We cut our profits. We hold our achievable profits, and we hope for here, but we never, I can't say never, but we rarely end up there. So let's fix that. Let's lock in what we can and say good enough is good enough. And, get those profits while they're there. And then also allow runners. All right, so we have formed new high of the day on SPX. We're officially green by about 93 cents so far. This is decent, but now it's got to continue, right? And then it's got to continue enough to the point where my contracts start to get some appreciation, because remember, I'm super far out of the money. My contract is all the way up here. So the longer the day goes on, the higher I need the price to go and more aggressively in order for my contracts to start getting bought up with intent. So even if you're right, technical analysis wise, you can still lose money on contracts, especially if you're far out. It's enough to lighten up the P&L a little bit. That's good. Chris is up 90%. I love it. Are you scaling out? Or are you going to hold everything? Charlie's still negative. Did you intend to trade SPX? Is this something I hope you're just not copying Pookie? You're gonna YOLO, Chris. Oh man. Oh boy. Well, you know the risks. YOLOing is fun, but this works for me because I get to use this as a tax advantage. That's primarily the only reason I really ever trade SPX. I don't make a ton of money with SPX. I do when I do overall, but all you need is to be wrong once if you're going to use bigger positions. So I always view SPX as kind of like the yield max ETFs. I use it more for the losses. And the profits are great. There are profits and it's net profitable overall, but most of the time I just use it as a release valve for my capital gains. And $25, that's not really going to matter much at tax time for me. So it's not a huge advantage. It's just ones that I sprinkle in over the course of the year. But again, if you're someone that is, if you're already over your limit for allowable losses, or if you're net red for the year, trading SPX kind of doesn't make sense if you're trading it for the loss advantage, because you've already got enough for your taxes, Let's see here. Stop hit, I'm pleased. So Fergie is, what'd you end up locking in on that one? Stop hit and pleased. That's amazing. So your stop loss will be $255 profit. Your take profit would be $655. That's awesome. So you moved your stop loss up on that. That's good stuff. Death Gun, I'm negative for the day. Pooks, what? Walk me through it, buddy. Are you still frustrated from Rainbow Six, from gaming? Because you kind of started the day saying that you wanted to hit something. It's an emotion. Not calling you out here, but just want to make sure that we're aware of that. You're chill now? Okay. What'd you end up trading? So at this point, on SPX, by the way, we got our candle close over my level, so I'm pretty confident in a bullish move at this point. If it just wants to come back and hang out in this range, it wouldn't surprise me, but this should, in theory, just absolutely start blasting at this point. And that's not a buy signal. I'm just saying what should happen. Doesn't mean it's going to. And my GeForce Game Ready driver is available that I never update. I don't want to. But yeah, walk me through what you traded. Was it EPOW and BENF? Or something different? EPOW? Okay. Were you doing the watch list entry with the candle close and all that? Or the range that we walked through? Let me just check something real fast. All right, so I think I might grab one of these. So I think if I buy, well, let me try to buy 3 shares. Just curious. So if I were to buy 3 shares right here, this would be the equivalent of 1 here and 2 here. So we would have hit both those entries. So I'm just curious if I can get filled on that. I'd have to move it up to 138. And I don't want to. Yeah, I think I'll just leave it at 137. If I get filled, I get filled. If not, that's okay too. I just want to kind of walk through this one in a way that makes sense. And if I miss it, that's okay too. So we'll see. But this would be an example, right? We had the range. The range was tested twice. We did, in fact, come down and touch it to the cent. And then we pushed off. I wasn't watching it. I could have traded it, but I did not. So I'm placing this order for 3 shares right here at 137 on EPOW just to simulate both those separate buys, because we would have placed a buy here and a buy here. So my average would be right here. You know what? So I will move this up. Yeah, we'll see if I get filled. Okay, so I did get filled. So now I've got my control 2. So if this moves down, remember, I've got this buy right here. This is my larger buy. So I don't want that to go below here, basically. So I want to keep a nice tight range on these 2 shares, 2 out of the 3. And then I've got a sell order, a sell range up here for those same 2 out of 3 shares. And then a sell order here for my 3rd share if it wants to go up. Okay, and then my sell order for my initial share, which would have been here, is just down here. Okay, so that's my goal. We'll see how that works out. Also, let me put up SPX next to this just so we can kind of see them side by side. Are you guys able to see that, hopefully? You should be able to see SPX as well. All right. All right, take care, everybody. I appreciate you hanging out. I know it's kind of a long stream, but I'm glad you got to hang out for a while. I'm going to keep hanging out. Fortunately, I get to hang out for a little while today. Trying to make sure I get plenty of access to you guys, so I can keep lecturing you about psychology and risk management as I blow a SPX 0 day. So let me be the cautionary tale. Don't copy me. Let me be the, let me take the hits on these. it fits completely within my plan to take that. So I can absorb it. Let me take a look here. All right, so Death Gun. It was the watch list setup, candle close, although it was between view app and MA20, and half my account is currently in HUBC. Okay, so what is your plan with HUBC, and does using half your account, is that an acceptable risk for you for that stock? Is that a swing trade or a day trade? I'm just curious. Again, there's no wrong answer. I'm just curious what your approach is. I'm just going to pop this up here so we can see the time and sales as well. Can't remember for the life of you. Okay. Do you have a written plan for it, or do you have it in the notes or anything where you can remember your original analysis? Or are you willing to do some analysis on it now so you can see if it still fits? One thing I'm also going to do is, in order to buy those shares on EPOW, I had to cancel my order on SPX. So I'm just going to set that up again. Just so I have it ready to go, because I don't have a hotkey that I don't feel like switching over and using on that one. No notes, but sure. Okay. So yeah, I mean, just let me know what your approach was on that one. And then we can, like, I just want you to figure out whether or not it still makes sense for you to maintain that one. Just so that you're not blindly holding with half your portfolio, because, you know, it's a little risky. G4, Slim, Radeon, FTW. Yeah, I don't mind mine. It gets the job done. Let me know what I have, honestly. I think it's a... let me figure that out real quick. Move that off the screen so it's not in your way. Got the RTX 4080 Super. So take that or leave it. All I know is I can play Arma. That's all I care about. All right. So on SPX, not only did we get a show of strength out of the orange box, we got a show of strength as a retest out of the yellow box. Now we're retesting the transitory blue box. So we'll see if this turns into a reversal zone, sorry, as it has been so far. It's just been a catch and release, but without the impulse. Now, if this can push through here and show us a strong impulse, that would be a great candidate for a clean push up through 66.77. And we'll see if we get our bigger move that I'm looking for. Because once we pop over that high, I think we should really see some juice on that one. Otherwise, we hang out. We don't do anything. Or I don't, I should say. Today's been rough on the old surface. Damn, dude. 97% memory, 92% disk. What's up with that? You don't have an SSD? What are you doing, like video downloads and stuff? What's going on there? Oh, you're running AI locally. Well, there's your problem. You got too much going on there, buddy. On the CPU, yeah, you get you a host, man. Get you a VPS for that. Don't run that stuff on your local machine. The only time that you'd really want to do that is if you were doing something illegal. But I digress. Stickman helped you build through the parts, go through the parts to build it last year. That's awesome. Good stuff. Oh yeah, BNF's popping. Look at that. It's over 90 cents, almost. Bloop, bloop, bloop. That's a nice shiny chart, sir. You scaling out? I sure hope so. Remember what I said, guys. Anything above target is extra. Okay, it's not expected, but it's extra. And a lot of times we can get those. Sold too early, but that's okay. I don't believe in such a thing, Top. I believe you sold exactly when you were meant to sell. I think that is a sum of all parts, and I think everything in the universe aligned for you to sell at that exact moment in time, and you walked away with a profit. So, if I know Top, it's the guy who will walk away with a small loss or a much bigger profit. And I think he did exactly that on this trade as well as every other trade. Okay, so HEBC is a channel trade at the bottom of its curve. Is that for a swing trade or a day trade? Swing, okay. Now you're in half your portfolio. So do you have a defined cut point in case that goes against you? And do you plan to add any more to that position, or are you fully committed? Like, is your allocation acceptable at this time? I'm going to break this chair one day. I look forward to it. Ooh. Ooh, yes, I can throw it off the roof. I have a nice concrete pad outside. I bet I could hit that. But I could land it on the concrete. Maybe I'll put a bunch of little rocks down so it doesn't chip the concrete. I don't know. Do we have any material physics engineers here? It's like a metal piston and some wheels, and I think that would turn that into a deadly weapon. Please stream that. I'd record it. I wouldn't mind getting some dynamite. Just boom. Maybe I'll. Oh no, I don't even think I could say pressure cooker on a live stream anymore. That was a joke. ATF, I'm joking. Ha ha ha. LOL. That's gone a semi-defined stop loss. And maybe I'm just playing too cocky, but I'm playing with all profits right now. Okay. So it's not going to put you in a position where you're net negative, but you have realized a profit, which means you owe taxes on that profit at a rate of roughly 35 to 40% in most cases for short-term capital gain. Now, the cool part, and this is the cool part, is now you're allowed to deduct capital losses against those capital gains as long as it's not a wash sale, right? Disallowed and whatnot. And that alone can help you calculate the position size of the next trade. So if it's a different ticker and this isn't a wash sale, you're allowed to deduct in most cases. Again, you have to talk to a locally licensed tax professional, but you can deduct 100% of your capital losses. Okay, I want you to write that down. 100% of capital losses. And you only pay taxes at a rate of about 35 to 40% in most cases on short-term capital gains if you're in the US. You see where I'm going with that? So about 65% of that money for those profits hasn't been taxed. You don't owe taxes on it. It's yours. You guys starting to see where I got the 70-30 split? Once we factor in dividend payments, share appreciation, capital loss sales for tax loss harvesting, and other forms of inflow and outflow in a portfolio. Is that starting to make sense? Charlie, I know it's making sense for you. I can feel it. Top says, wish I could do that. My taxes for trading went up from 10% to 33%. Crazy. Yeah, I can imagine. Belgium is different. That's terrible, man. You guys got like some runaway taxes over there. It sucks. You got to scoop up you, your dog, and your girlfriend and just swim over here. Just paddle. Just get a paddle real fast. Hitch a ride from someone heading down from Alaska to go get their DVD. in Bend, Oregon. Death Gun, it sounds logical, but I don't understand the math. Okay, that's cool. That's perfect. So you have the concept, but you don't have the specific to fill the gap, right? So when you realize a profit, let's say you realize $1,000 profit or $100 profit. Let's keep it small. $100 profit on a position, you would typically owe about $37 in taxes just on that one $100 profit, right? So when tax time comes around, the government's like, hey, how much did you make in the stock market? And you're like, I made $100. And they're like, cool, give me 37 of it, right? And then the government's going to ask you, hey, how much did you lose in the stock market? And this is all stuff you do in a worksheet. Like, it's not like you don't pay taxes on profits separately from your losses. It's combined. So it's a net sum. So if you made $100 and then you lost $100, you would not owe taxes on that in most cases, unless it was a wash sale, because then the loss becomes disallowed. So it's a little bit more complex. But if you just made $100 in January and then you lost $100 in June, you'd be break even. You wouldn't owe any taxes on your trading in that very clean, very vacuum, sterile case in most cases, right? There's always got to be a disclaimer because I can't give you guys tax advice. Now, if you made $2,000 and you lost $5,000, you'd be able to claim the net negative $3,000, again, excluding wash sales or disallowed losses, towards your taxes, and you would be okay in that case. Most traders lose money their first year, so they don't really understand it, and they get very stressed out thinking about, oh, I have to pay taxes this year on the profits. You don't. Most of the time, if you're net negative and you don't have a bunch of wash sales, those negatives outpower the profits, and you usually don't owe taxes on your trading. So that's worth understanding first. So now, with that in mind, if I get money in, whether it's a contribution that I've earned, or it's a dividend payout, let's say I get a dividend. Let's say I get a $100 dividend. I need to pay taxes on 35 to 40% of that if it's a short-term payout, which in most cases it is. Let's say it's not a qualified dividend, because it's income, right? It's money that I'm being paid from the market. So it counts as a capital gain. Now, if I don't offset that with something like a yield max ETF that I sell, or an SPX trade that I sell for a loss, that profit I owe money on, right? And I get a bunch of them. So I got to offset those. And that's where taxes come in. So when I get a $100 dividend payment, for example, I want to put $70 of that into investment, or all of it into investment, so that it continues to grow. But I want to offset the taxes as much as possible. So I take a portion of it out and I pay my taxes if I have to. I try to do estimated quarterly payments and I try to offset as much as possible. But when you get up to a certain level, you're just going to run out of deductions, and it sucks. So you really have to do things like tax loss harvests, and you have to just take losses, because I'd rather take losses in the market that offset my capital gains and get in lower tax brackets and get better rates overall than I would pay the taxes. Because again, why pay a higher rate? It's like a lower interest credit card versus a higher interest credit card. That's how you have to view taxes at the end of the year if you get up to a certain level, because you're just paying extra for nothing. You get the same thing, which is inadequate representation, in my opinion. But why pay extra for the same thing? And it sucks, So I try to reduce my tax bracket as much as possible, and I do that through tax loss harvesting. So I still walk away with cash, but I also pay less than everyone else who made the same amount of money because I offset it, if that makes sense. So it's just a math game. You literally have to treat it like a video game at a certain point. There's just little rules and moves and buttons you can push, and little strategies you can do. And the more of those the better off you are. So let me catch up on the chat here. Fast Subi, if you have more than 3,000 in losses to write off, how does the remaining difference follow to the next year? Is it on the year-end statement from a broker? So you're referring to indefinite carry forward. So let's say you realize a $10,000 loss in a year. You can only claim in one specific case where you were like a single head household, you can only claim 3,000 of that 10,000, which would leave 7,000 remaining. You would be responsible for carrying that forward, which in that case, I assume you have a CPA if you're dealing with 5-figure gains and losses, right? So in that case, you would want to track that from year to year to year. And I encourage everybody right now, if you've been trading more than a year, look back at your last 2 to 3 years. You can file an amendment. If you've lost thousands and thousands of dollars in the market, you can file an amendment like now. You can get some of that back. They're not going to cut you a check, but you can say, hey, IRS, I overpaid because I didn't claim these in the moment, but I'm entitled to these, and you can literally call the IRS and have a conversation with them. They're not all monsters. I just don't like paying them more than I have to. It's like a credit card company. They offer a service and they're just doing their job. I get it. But they will walk you through a lot of stuff if you just talk to them. Because they want you in relatively healthy shape, because they want you to be able to continue paying, because that's how they make their money. They're not going to be your best friend, and they're going to make sure that they talk a certain way. But if you have a general question about how taxes work and you have the opportunity to set something straight, they're going to want to hear it because they have an obligation. So anyone who has been trading more than, I would say 2-3 years, look into it. There's a lot of stuff that goes into taxes that people just don't know, even if you've been doing it. Like Deathgun, you've been helping your mom do her taxes since you were 15. That's awesome, man. You're at a young age. You're well beyond your peers at this point. I want you to excel even further. Grab onto that. Understand finance as much as you possibly can. It's the one thing in the world that can change your life drastically, for better or for worse. And the more fluent you are in that particular language, the more options you're going to have when it comes time to dealing with uncertainty. And I don't want anyone here to just eat ramen and lock themselves in a storage closet and not spend money. But understanding financial literacy is definitely a critical life skill, and you're not going to learn it in school. So it's awesome that you have exposure to taxes and you understand how they work. Just understand that there's always more. You can always learn more, do more, even with just a simple 1044, right? Just generic income taxes. There's still other things that you can file. There's still all the credits you can look into, even the ones that aren't listed in TurboTax. There's always something that you can get in most cases. So just keep going. Fergie, the lady I spoke to at the state comptroller office about small business stuff, is retired from IRS. You learned a lot in that conversation. Absolutely. Like Duck says, your network is your net worth. I learned a lot of the stuff I know about money from people that have a lot of money. Like just getting out there and working for them, starting up conversations, having the social skills to just talk to people and ask questions and get to treat them like a human. Because at some point, there's kind of a wall that comes up for a lot of those people. It's a distrust, because a lot of times people interact disingenuously, I guess, unauthentically, because someone has money or because they have status, and it tends to be a little exploitive. So they put a wall up. But if you're just talking and you're non-threatening and you just have a genuine curiosity about them and what they know, a lot of times you can get a lot of valuable information out of somebody. If you really, really like ramen, I encourage you to follow your dreams. Just make sure that you keep an eye on your sodium and talk to the doctor about the downfalls of strictly ramen diet and lack of sunlight because you're in a storage closet. Yeah. Your body needs to produce vitamin D. There's complications. All magic has a price. With that said, I'm also a fan of bodily autonomy, so I get it. If that's about to get dark, but if that's the control you want to take, I'm not going to stop you. Yeah, there's a lot of sodium in them. Sodium and wax. Top. It says, exactly, it's crazy the money I spent on trading is money from working. So I paid already 55% taxes. Belgium is the country with the highest taxes in the world. That's not a lie. Yeah, that's insane, dude. Even here in America, the The US dollar is taxed 8 to 12 times along its life cycle before it goes into like a savings account, which is stupid. It is absolutely stupid. The government has a vested interest in keeping money circulating. They want money flow, not surplus, not inflow. They want money flow. And banks want the same thing. If you want to look at the fractional reserve banking system, it is exactly what the US government does. Every time money changes hands, there is a cost. It's either a debt or a surplus, right? And what happens is that liquidity, that circulation of money gets constantly skimmed. There's a service fee. Think of it like a gas fee in crypto. Every time you convert something, it requires computing power, which means that you pay a fee. All right. Taxes work the same exact way. Every time you change hands, when you buy a candy bar at the store, you pay taxes. It's a micro fee. It's 8%. It's 6%. Depends on where you live. Some states don't have any tax for sales. They have other forms of tax. If you live in Belgium with Top, if you live 3 blocks down the street from Top, you're going to pay 55%, according to him, on your income, meaning that you go to work and you take home less than half of that, which is, that's also something we tend to experience in America, but there's other things coming out of our check rather than just the federal tax. But it's a good chunk of it. It's 30, 40% for a lot of people. And that sucks. Some people have it much lower, and that's awesome. Good for them. But for a lot of people, the tax rate is just too high, and we just endure it. We grin and bear it. We complain about it. We get frustrated. We get discouraged, but we endure it. So any chance we get to arm ourselves and kind of change that about our financial circumstance, we should take. If I pay taxes on 35% of my income, and I now know a way to bring it down to 20%, I'm going to do that because I want that extra 15% every time I get paid. You wouldn't turn down a 15% pay raise. And I know it's not exactly how percentages work, but you guys get the idea. But the government wants money to circulate. They want it to go around faster and frequently because that allows them to skim more frequently. It's like a casino. Their wins aren't huge in a lot of cases for a casino. It's the frequency that brings them up. Banks loan out money. There's a specific formula that banks use to determine how many times money can be loaned in a cascade before they see diminishing returns. I can't think of the exact word. I think it starts with a G. It's not the Gordon growth model. It's for something else, but there's a specific ratio. And that's what they do. Like you bring $10,000, you put it in a savings account. The bank's going to loan out 9,000 of that. Someone else is going to get that $9,000. They're going to pay interest on that. They're going to pay it back ideally. And then 8,000 of that goes into another savings account, or it goes towards a loan or something, something that gets paid, right? Maybe it's a down payment on a house. Then there's $8,000. They're still paying the interest and the principal on the $9,000, by the way. Maybe they pay 8%, and the bank's going to give you 2%, right? That spread is how they make money. So now they repeats this process: $8,000, $7,200, $6,300, $54, all the way down, right? It's all 90%, whatever. Just over and over and over again. And then there's just a stream of incrementally smaller interest payments flooding in on that same $10,000, which increases that 8% the original person is paying you. But you're still getting paid 2%. Doesn't that suck? It's your money. They're loaning it out and they're making money with your money. But you're not getting paid anymore. They just found a more efficient way to loan out your cash. And if there's enough people depositing cash, if you want to just go and get your $10,000 back, they can. They can just pay you. And then they stop paying you interest because you're no longer letting them borrow your money. That interest goes to someone else. That's essentially how the fractional reserve banking system works. And there is a finite number of times where they can loan out that amount before the amount of loans is just not providing enough income for it to be worth it, because the loans just get too small, right? And we need to find ways to do that as well, because if we don't do that, We're just subject to, we contribute to money flow. Like, here's my money. Great. Hold on to it. Give me 2%. I'm happy. Maybe 3.5%, 4% if it's a high yield savings account, maybe up to 6%. Maybe we put in a 401k. But why can't we do that for ourselves? Why can't we go out to the stock market and say, hey, stock market, I want to buy these shares. Here's some of my money. In the expectation that you're either going to default on that and I'll take a loss, or you're going to pay me money back and I'll have more than I started with. You're going to pay me some rate of return, right? Ideally more than 2% per year, but we get what we get. And you say, okay, that's great. That's loan number one. We're loaning the market our money with one of two outcomes happening, right? Simple. But there's more. So now we say, okay, market, I want more money. How's the market going to do that? The market's going to say, well, I got some options for you. I got some other ways we can make money. And this is something the market's not going to tell you. It's something that someone like me is going to tell you, or someone like Bull, or someone like Lee. Maybe you stumbled across it on a YouTube video. But, another way to get this money is to say, okay, well, instead of just buying shares down here, why don't we get paid to place the order, right? Let's add a layer of abstraction to that. And we can use something like a cash secured put. Because we want to buy shares, why not get paid to place the limit buy order, which is effectively what a cash secured put is, right? So we've effectively bought shares down here, but we've made more money to do so. And then when the price goes up, we could say, okay, market, it's time for me to cash out. I want my money, and this is me getting my 2% per year annual return. I'm closing the loan out, right? I made more. I like it. I'm happy. The terms are good. I'm walking away. And then the market's like, okay, here's your money. So you've bought the shares. You have a reduced cost basis. You make a little bit more. And then instead of selling with just a regular limit sell order, why don't we get paid to place that order as well? So then we could place a covered call, right? We squeeze just a little bit more profit out of it. And then let's extend this out over a longer period of time. And then we could say, oh, let's add some dividends in. Let's collect some more money. Right? And we say, oh, wow, look at that. We're making even more money. We found a way to make money 3 times in the same stock. Whereas, person A is just buying and selling. We still get that range, but we also get paid extra here and here. And we also get paid extra here, 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 and here, and here. Right? So now what can we do with this extra funding? Right? We've got this here. We've got all these. We've got this one. Let's compile those into something that we can use to our benefit. And what do we do there? We say, okay, we've got some options. And what do we think we can do here? The answer is pretty much anything we want. It's free money, right? The risk we took was exactly the same. We didn't take any extra risk. We still bought shares here and we still had a stop loss here. We just got paid to place the order, paid to hold the shares, and paid to sell them, assuming everything went in our favor. But now we've got that extra money just chilling, and we just skimmed it because what we've done is we've capitalized on the money flow the same way the government does, the same way banks do. We just found a way to translate that same concept into the market. So we've got paid 1, 2, 3, 4, 5, 6, 7, 8, 9 more times than someone who would have just bought and sold. Well, 8 more times, I guess. So 9 times total. So 9 minus 8 is 1. So why the hell aren't we doing that? Right? And that's the same concept as, and just understanding financial flow and basic financial literacy can open those kinds of doors for you. You just have to have the skill set and you have to have the insight. And you're not going to get that in a YouTube video. And that's why I hate those YouTube gurus, because they just put profit porn in front of you and be like, oh, copy me. That doesn't work. Because there's any number of ways that we can get, like just on this stream, right? We've covered zone recovery. We've covered the additional skims that institutional traders do along those ranges, right? We've implemented it here so far, just on this one example trade that's taken forever. And then as well as the aftermath, like the chain fills and all that good stuff, the breakouts and the distribution and all that, right? Then we've covered the fractional reserve banking system, how the governments work, how they skim interest and encourage money flow, because that's how they skim. And then we've also just directly applied it to a trade that we could have theoretically taken if we find a quality stock that's doing what we want it to do. We just decide that we want to participate, and then we decide how. Right? And that's stuff that can all be planned out ahead of time. But the problem is if you don't have a plan and you're just kind of winging it, you're not going to be efficient. And the more losses you take, the bigger losses you take, the fewer opportunities you're going to have to become efficient. I love wings. I do. I like the bonus wings. Boneless wings. Bonus wings. But does this stuff make sense? Like, it goes so far beyond just buying and selling and just looking at candles. Like, I hate when people reduce the market to just that, because that is gambling. And that's, I agree. In that context, you're just gambling, because you're just buying and hoping the price goes up. But you need portfolio allocation, you need position management, you need the psychology and discipline to actually execute when the market tells you it's time to execute. You need to establish financial stability outside the market. You need to have clean visibility of your budget and, chaos hedges in place just in case. That includes insurance, emergency savings. You need to have good credit. You need to be building your credit or maintaining it. Even if you don't believe you do, it is very helpful, and it doesn't cost anything to build credit, which is another lie that you see on YouTube and you see in ads because people want you to buy their credit building services. Who here makes a regular habit of checking their credit report and disputing things? Let's put a 1 in the chat if you do, 2 if you don't. And how often you do it. Yojo says 1, Top says 1. You guys are quick today. Charlie does it every week. Oof, aggressive. Yojo, my brain translated that into every 6 hours. Because, that was great. Once a month. I thought Charlie just wakes up every Friday morning just angry. Like, listen, I said I don't owe you. I don't know what my brain said once every 6 hours, but that would be intense. Fast CB has your credit frozen since it shows Social Security number leak. Okay. And that's a factor too. That's a unique circumstance. So that's something you have to consider as well when it comes to managing debt and the cost of debt maintenance and things like that. So there's all kinds of little quirks and stuff like that right there that you just mentioned, Fasubi. That's why it's unethical and also illegal for anybody to tell you what to do with your money. You can't go out and get a HELOC. What kind of rate are you going to get? I can't tell you to use the HELOC for consolidating high interest credit cards, for example. A, I don't know if you're a homeowner. B, I don't know what kind of appraisal you might get. C, I don't know what your credit situation is. And D, I don't know what kind of bank you have. Are you a credit union? Are you a local bank? Are you a national branch? No idea. Zero insight in that. So for me to just blindly belt out advice, that would be stupid. It'd be irresponsible. That's why I don't tell people what to do with their money. I teach you how to make decisions because I want you to survive without me. I don't want you to rely on me. Doing math is easy. You got tools in AI and spreadsheets and calculators and all that good stuff. It's just a matter of piecing it together, I think, for most people, and then understanding the story behind why you're doing it. So I can't tell anybody what to do. And that kind of makes it frustrating. And I know, I'm sure when people ask me, should I sell my stock here? I can't tell you yes. I can't tell you no. I have no insight into what you're seeing and what you're feeling and who you are as a person. I don't know your personality traits. I don't know your resources. How much of your portfolio is it? How many portfolios do you have? What's your financial situation outside the market? Is it a blow you can easily absorb? Are you looking for tax advantages? Are you Were you originally planning to build that position down and add more? Like, I don't have that information, and I'm not going to dig too deep to get it. So it's just not worth it. So that's why I don't like seeing people copy anybody. Sorry, I go off on a little rant there. But that was a good point. That's, having your credit frozen is a unique circumstance. That's not something that's as common as having, XYZ type of credit. Yeah, exactly. Go to someone that has better access to your stuff. I don't have good access to your stuff. I have deep reliance on what you tell me. And that's reliant on what you understand your situation to be. So like if I was a doctor, I can't rely exclusively on what a patient tells me, because the patient might just be misinterpreting something, or they might be using the wrong term. If I say is something a stabby or a sharp pain, how many people are going to answer that objectively in an accurate way? Because sharp and stabby are close, but they're not the same. People might just mix them up. So I got to look at other stuff, and it's not my job to look at that stuff. It's your job. You're the patient. You're the one that suffers if I do my job wrong. So go to someone that can access things, can look into things, and get, they can get records and stuff that I can't. They can look at reports that I can't. I can't talk to a bank and say, hey, blah, blah, I'm credentialed and blah, blah, blah. Like, absolutely not. And that would be silly, to have some guy in Discord do that for you, no matter who it is. It would raise some flags. I'll tell you that. So let me catch up on the chat here. Sorry. Stickman, I've gotten it over 700 in the past 2 years from it being below 550. That's awesome. That's a great rate, man. You increased your credit score 150 points in 24 months. That's solid, dude. And once you get over 760, again, you get those favorable rates. You don't have to push it over 800. That's just kind of elite status if you can get over like 820, 860. But you don't need it up that high. Over 800 is great. Fasubi, I had my credit over 800, paid off a car loan early, and it went down. Made no sense to me at the time how it all works. Yeah. And that's because you closed out a seasoned account, basically. So you reduced the mix and average age of accounts when you paid off that loan. So that sucks. And we just don't know what we don't know until we know, right? The same is true in the market. You can absolutely learn things the hard way if you want, but why would you do that? That's like trying to figure out like schizophrenia without going to a doctor or a therapist. Like, you could tough it out if you want, but it's probably going to be messy. Yeah, exactly, Doug. There are financial advisors for that. And again, that's just, they have more in-depth conversations and they can access things a lot more closely. Death Gun, I use my credit card for gas and bills and never have it more than 30 to 40%. Let me tell you right now, you are hurting yourself if you keep it around 30%. Did you know that? Did you? And if you want an 800 plus credit score by 25, you are probably not going to get it. No offense. And I'll tell you why as soon as I know that you heard what I just said. Duck does not owe his credit score. We're going to fix that, buddy. We're going to build up your financial foundation because you have a kid. You just had a new baby. We're going to get that diaper fund rolling. You did hear me and you didn't know that. Okay, so basically there's predominantly 5 factors that go into a FICO score. The biggest and most impactful one is your repayment history, because banks want to know that you can pay them back on time. So late payments and stuff hurt you really badly. That's about 35% of your FICO score right there. So just making consistent payments is huge. And another item there is your utilization ratio. And the reason why you don't want to use 30% is because, let's say I've got a $300 credit card. Let's just say I went out and got like a brand new credit card, no credit history or bad credit. And I just got a beginner card, right? So I've got $300 of credit. I'm going to use 100 of it to keep it 30% or below, or $90, whatever. What does that tell the bank? It tells me that I have to use my debt, right? I have access to it and I can use it, but the bank doesn't want me to use it because they want me financially capable, right? They want me to be able to use my non-debt money because they want to hold on to as much as possible. They don't want to loan it out to me when I need it. So your best bet is to reduce your utilization ratio as much as possible and have access to as much credit as possible, but use as little as possible so that your ratio is ideally less than 10%. So what I do personally is I just constantly take out new cards when it's appropriate. I've got a bunch of them, so I don't need to do that, because that also works against you. There's diminishing returns there, and I'll get to that in a second. But I'll buy a soda once a month, or I'll buy a snack once a month. After the statement date, so because I don't want that to report until the next month, and I'll pay them off on time. So as long as you pay it off between the statement date and the due date, and then after that, you use it again for the next statement date, what's going to happen is your credit card company is going to report on your statement that you've used a very small amount of your debt and that you paid it off on time. And those are the two biggest factors. So a very low utilization rate and a very high rate of on-time payments. Yeah, and getting credit limit increases also helps because it reduces the amount that you've used because you have more available. So that's another great way to do that. Now, every time you take out a credit card, for example, or open a new line of debt or new line of established credit, you do take a credit hit because it counts as a hard inquiry. So you have to be mindful of that as well. So if you take out 5 credit cards back to back, your credit score is going to take a hit. And again, this is just general education. Always do your own research and all that good stuff. I'm not a financial advisor. I'm just telling you guys how FICO scores work and things like that. So the general approach for someone who wants to build credit quickly would be to take out a, ideally a 0% APR credit card if you can. They're not always available to people with poor credit or no credit, but there's usually something out there. Usually get like 0% APR for the first month. And let me just take a second here really quick. I know this is kind of a rant here. We're going off the path. But I want to talk about how credit cards actually work, because that's something that's misunderstood as well. If you have a credit card that has a $300 limit and your statement date's on the 10th of each month, right? Credit cards usually use the same date. And let's say you use $290. Okay. The credit card company is going to report whatever your balance is on the 10th. So you can pay all that off before the 10th. But if you keep $1 on there, it reports something. And that's what you want. You don't want it to report $0 because then there's no report. You want it to report some low utilization so that they can keep the card active and report something to the bureau. And that's what helps your score. So if you need to use all the money on your credit card, as long as you pay it off before the next statement date, you're okay. And that's what they're for. That's how credit lines work. But if you don't pay it off and you've got $290 and it gets reported, that's a very high utilization. That'll bring your score down. Breckle, I haven't used a debit card in 20 years. His score is 832. That's insane. Congrats. Welcome to the club. But I'm willing to bet you also have very seasoned age of accounts. You've probably got a good credit mix. Like you've probably got loans. You've probably got property. You've probably got a diverse type of loans. You've probably got several cards, I would imagine. And you're probably very good at paying on time. And if you really want to push in the higher levels, you have to really nail down, low utilization ratio, excellent repayment scheduling, consistent repayments, like don't miss anything. Your accounts need to be seasoned. You can't have a thin file. And what that means is that you don't have a lot of reports. So like a mortgage, the longer you keep a mortgage, and this is why mortgages are good, you want to amortize when and where you can to pay down the rate that you're paying, because that reduces the interest. But the longer you have an account open, then the better your credit score becomes, because that's also a factor. Your average age of accounts, it's kind of a hidden metric, but it does matter in terms of showing your credit worthiness, because it shows that you were able to maintain those lines of debt without defaulting, without having it sent to collections, without paying it off early and not using credit, or whatever your established line of credit is. You also want a good mix of types of credit, like again, a mortgage, like a HELOC, auto loans, personal loans, credit cards. There's many types that you can use. So you want to have a good mix. Because if you just have all credit cards, you'll get there. It'll just take longer. But you really want that seasoned age of account. So what I do is I've taken out a bunch of cards over time, right? Strategically placed apart over time to make sure that it can recover from the small point hit that it takes when you open a new card. So if you're a newer, student loans is a good one. It depends on whether or not it reports. So that would require some digging. It would kind of depend on how it works, like what kind of system the loan was acquired through. But let's say I'm a brand new trader, right? Let's say I just got out of high school, or my parents didn't set up credit or anything in my name. I want to start building credit as efficiently as possible. What the hell do I do? Right? I just got my job. I work at McDonald's. I got to build credit. Okay. So one of the easiest things you can do is take out a credit card, right? That's what they're for. There's, Capital One. I think they have the Quicksilver credit card for people that are trying to build credit. It's a lower APR. In some cases, you can get 0%, but it really depends. I think Discover has another one too. I can't remember the name of that one. But you just take out a credit card and just use $1, right? Keep that utilization ratio low. And again, this is not financial advice. I'm saying if I were to try to build new credit, as a brand new person, not a little floppy newborn, but like a legally capable person that can handle my own responsibilities, and getting that credit card out is immediately going to cause you to take a hit. It's a small hit. It's like a 5-point hit, something like that. It really depends, but you'll have an increased line of credit. So it'll balance out over time as long as you don't abuse it and as long as you don't miss payments. Right. So your credit score will naturally grow back the longer you use the credit, as long as, again, don't overuse it. And there's also credit builder loans that you can get from many banks, or especially credit unions, because they want you to have a higher credit score because they want people that'll pay them. And the way that works basically is that you open a loan, and instead of the bank giving you money, it's a couple $100. It's not huge. And there's different terms on them. You can do 1 year, 2 year, whatever. So let's say you do a $500 1 year credit builder loan. Instead of giving you the cash, they put it into a CD or something similar that'll generate interest ideally. And then you make your monthly payments on time. And this is where it does kind of cost money to build credit if you take that route, but it doesn't cost money if you have a 0% APR credit card. And I'll get to all that later. But if you just make your payments on time, at the end of the term of that loan, you get paid all that money plus whatever interest it accrued. So it can offset. So let's say you get a 6.5% interest rate on a credit builder loan, or 8%, whatever. And, they put it in HISA for you, and you got a 4% APR on that same amount of money over a year, over $500. You're not talking about huge amounts of money, but you've done 12 straight payments over the course of a year on time. You paid very little net in terms of building that particular piece of credit. And you now have a year-long seasoned account, which is now closed though. So that's kind of the drawback, but your credit score is up higher, right? Because you've successfully managed loan and you've paid it off on time. And that's kind of what credit scores are built on. They just want to see that you can pay back your debts and manage your debt and not abuse it. So the goal for a bank, right? If I'm a bank, my ideal customer is someone that's going to be like, hey, I need access to money, but I don't need to use it. And I'm good for paying it off. You know me. Here's all the stuff that proves that I can pay my stuff off. I got plenty of money flow. I got a history of paying all my stuff off on time. And I've got a history of using money actively. Because remember, banks make money on money flow. So they want to collect that interest. They don't want people that are going to default. They're not going to loan to people that they don't know and that they can't trust. It's like loaning money to a friend versus someone that you just saw at a gas station. I'm going to loan money to my friend if I know he can pay me back. That's all it boils down to. So yeah, you don't want to use 30 to 40% of your credit card, because that shows that you are using 30 to 40% of what they're giving you access to. And they don't want that. They want to sit on their money so they can loan it out to people and charge higher interest rates than what they're charging you. And if you want to, use it, you can always pay it off right before the statement date as much as possible, while still keeping at least like $1 on there. And then you get the best of both worlds. You get access to the money, you get to use the money, as long as you pay it off, right? And then you get that report. It's an on-time payment. It's a low utilization ratio on that report, and your credit goes up. But much like dealing with low float stocks and speculation, that's not going to carry you all the way up into the higher elite levels. You need age of accounts. And that's where we can stagger cards. We can take out one card in January. 6 months later, we can take out a second card, right? Your credit score should replenish. And then taking that second card out should set the point back down a little bit. And then it'll replenish. But now you'll have even more credit limit. And you'll have more reporting. You'll have double the reporting. Yeah, plus reward points if you get into that. There's travel hacking and things like that. I don't personally get involved with that, but that's a good way to do that. And then mixing it up with different types of loans and different types of credit. That's all really, really good stuff. And then by the time you get, auto loans and mortgages and HELOCs and things like that, different terms, personal loans from the bank, outside credit builders, there's all kinds of ways you can exploit the financial stuff and get a really efficient growth on your credit score. And that having a high credit score is important. Like, I've already rambled about that quite a bit on other streams, but like, there's such an advantage in having a good credit score. So don't sacrifice your credit score because you don't think you'll need credit. And don't sacrifice it because you think you have to live in debt. You don't. You want to use as little as possible. You just want to have access to a bunch. You want banks to trust you, and you want other banks to see that other banks are trusting you. That's how you get lower interest rates. That's how you get approvals for things a lot easier that don't apply to loans and financial stuff. Like, you can get refused an apartment rental if you have a bad credit score. I was refused security clearance, and I had to jump through all kinds of extra hoops when I was in the Army just to get security clearance because I paid cash for everything. I didn't think I needed credit. So, now I know. That was very disruptive. I didn't enjoy that. But I know I went super far off the rail there. Let me just catch up on the chat here. So Death Gun, I heard you say that 30 to 40%. I wanted to clarify that. So I do teach a lot more in the lifetime side, but we'll get you there. Credit is a great way for people who aren't ready to get in debt. Yeah, don't use debt. Like, don't land in debt, especially unhealthy debt. Maintaining debt is a delicate art, but there's also very healthy debt. Because remember, if you have a good quality credit score and you can amass tax-free money, which is what debt is, and then use that money to generate insane amounts of income passively, enough that it'll cover the interest on the low interest loans and things like that, collateralized loans, it's free money. As long as it pays for itself, it's free money, and you can just cycle it and compound it. And that gives you access to much more money than you'd normally have. And that's the appeal of prop firms, is that they give you access to money, but that's a scam. In most cases, it's a scam because they just get their money from you paying for the tests. And they use simulated data to make sure you don't pass in a lot of cases. And I don't want to see you guys fall into that. So let's do it the right way. We'll do it the same way that banks do it, and we'll understand the system a lot more effectively. And we'll be able to use it in a more functional way, and we'll build ourselves up, and we'll make sure that we understand things the right way. This free stream turned into a masterclass of all things finance. It's been going for a little while. The longer I talk, the longer I'm going to ramble. Duck says, I'd rather just pay the mortgage off as soon as possible and not have to pay the bank more money. So that's awesome, but you're sacrificing a wonderful asset there. By asset, I just mean the idiomatic form. It's not actually an asset. The house is an asset and it depreciates. But the mortgage is a wonderful resource because it is a huge credit limit increase, and it is a very seasoned age of accounts. The balance there is how much interest you want to pay. So that's why I recommend amortization if I'm allowed to. But even that, if you don't have a good credit score, that mortgage is going to be brutal because you're looking at, let's say you get a 30-year term, right? It's 360 payments. Yeah, that suck. Yeah. Let's say 8% interest or something. That's going to be rough. You're going to pay so much more in interest than you have to. You're talking 5 figures on a 6-figure mortgage. Easy. Just extra money, just paying it to the bank for no reason. More than you have to. Sorry, I'm just trying to catch up on the chat here. Exactly, Crimina. Little personal loans, don't use the money. Use the money to pay it back. That's a legitimate strategy. Now, that's a less efficient way, because what you're doing there is you're effectively just buying credit, which is okay, but there's ways that we can use that money to pay for the loan itself, right? And that's where, like, let's say you get a really good personal loan at, let's say it's like a year, right? And you just want to pay it off, but you want to, let's say you get like a 4% personal loan. Just say it's say you got a good credit score and all that good stuff. You're just looking to keep an active account and rotate and stuff. Let's say you put that into a high yield savings account, get 4.5%. Why not do that? Over the same period of time, it pays for itself and you get paid. So you take on a loan, yes, you get credit increase, right? Your score goes up and you get a little bit of extra money at the end of the year for it, just for having that money flow and providing it to a bank. So in that case, it's just shopping around. Now, getting a 4% loan takes a little bit of work, but there's wonderful, wonderful ways to do that. But it's a lot easier when you have a good credit score. So if you have like a 560, you're going to have a very hard time finding anything like that. So that's why you got to work on other ways to build that credit up first. Discover has a secured, secured versus unsecured as well. That's another element to that. You send them like $200 to open and buy something small like once a month, and in a few months they'll send your money back and you have a real credit card. Absolutely. It's just like a CD, but it reports to your credit. Fergie prefer using a credit card for most purchases for several reasons. If my account is breached, I simply dispute charges and the fraud department will deal with it. If I use a debit card, they actually get into my money. It's much more difficult to get it back. Absolutely. They will freeze everything you have. It sucks. It's excruciating. And it can take like a year to 2 years in a lot of cases. It's not fun. Credit cards have insurance built in for purchases that end up being scams. So they have a layer of protection for online buys. Absolutely. Let them do all the work. They're the ones that manage their own risk. You're just accessing a portion of it. And then you pay off the credit card every month, which keeps your credit score well into the 800s. That's awesome. And if you miss a payment, it's not fun, So that repayment history is the number one. Always pay on time when you can. And if you can't, then it's worth calling a creditor and saying, hey, is there any way I can reschedule this one specific payment date just till after whatever? And it's worth a phone call, at the very least. I'd rather quit coupons. Yeah, I hear you. It's not for everybody, and I don't want any part of it. I don't need to. Fergie says that is a whole additional conversation. I did a deep dive into the most effective way to use points for travel. Talk for an hour on that. Yeah. Think you're going to take out some subsidized student loans? Well, consider the interest rates and the strings that come along with those. What are you allowed to use them for? That's a big factor. Does it report? What kind of fees and penalties and rates are you looking at? How does it play into your taxes, right? Because certain loans have different tax implications. And that's where, like, I can talk about this stuff. I can ramble about, how to build credit and how to manage debt and stuff like that. But at the end of the day, it's going to take a deeper discussion for you to fully understand the implications of that stuff. And that's where it takes time and education. And then even on top of that, you still have to do your own work because you are the only one that has your full picture. And maybe a financial advisor, but I start here. I start with education. I just put things in front of you guys to show you that it's possible, that there are options. I lay everything out on a table for you. Then we pick up one piece at a time, depending on whether or not you're, a newer trader in the free section. Maybe you're new to the server, new to trading. We'll talk about something less complicated. If you've been with us for a while, maybe you're in premium or on the free side, we'll talk about something that's a little more complicated. If you're in lifetime, I'm pretty sure you're already relatively well financially stable at that point, and most lifers have been with us for a long time. So we'll talk about the deep stuff. So today, this is just concept stuff. We're not really, I'm not listing out all 5 FICO score factors plus the hidden ones, and then talking about the different types of loans and different types of accounts, and, walking through case studies of credit scores and all that good stuff. And we're not talking about like full-on portfolio structuring and different types of retirement accounts and all that good stuff. We're not shopping around for credit card pros and cons and fee schedules and talking about how to dispute claims with creditors. And like, it's a lot. You gotta spend some time and learn it. But the number one thing I want everybody here to learn is how to just stop bleeding out so profusely. I say that and I have a 0 day that's 70% down. Ignore that. But that's the thing. Like, we have to learn to stop losing as much. And when I say as much, I'm talking about the quality of our losses must improve if we want to be successful long term. If we're taking losses for tax advantages, that's a different story. If we're taking losses because we don't know how to not take big losses, that's the main conversation I want to have with you guys. So we can build all the other fancy stuff on top of it. We can build financial literacy, become financially stable outside the market. We can build credit. We can build emergency funds. We can talk about the different types of debt and different impacts of debt versus credit. We can talk about depreciation of assets and tax implications and all this other stuff. We can talk about investments, the different types of accounts, CDs versus bonds, for example, versus HISAs. And those are just forms of liquidity. And we could talk about how fractional reserve banking systems work and secured versus unsecured obligations. As an example, we can talk about collateralized debt obligations, both on our behalf as well as companies that we're trading. We could talk about portfolio structuring. We can talk about position management. We can talk about technical analysis strategies, different order types, conditional orders, types of spreads. There's a lot that goes into this, but it doesn't have to be complicated. I'm sorry, Charlie, I went down the hole. I see demons. You guys understand that there's I know a lot of shit. I'm not trying to I'm not bragging or anything, but there's a lot that I have to teach you guys. And staying on task is hard, but it's easier when we prioritize things. There's an information hierarchy. And if you don't prioritize your information, everything will be equal. Everything will get lost in the noise. There's a statistical word for that. I can't remember what it is, but everything just kind of flattens out and it gets messy, and that's when the inefficiencies take over. So you prioritize things. You prioritize your financial stability outside the market, right? I harp on that every day now. Prioritize building your credit score and maintaining good credit. Doesn't mean you have to be in debt. Doesn't mean you have to pay extra. You can get paid to build your credit if you do it the right way. And then making sure that you're making consistent contributions and focusing on building passive income so that you're not reliant on speculation exclusively. The rags to riches guys, you guys nailed it. You just contributed repeatedly to an account, put most of it in passive income, and the accounts just kind of magically grew, right? Because you weren't giving back as much as you were putting in. That's the general concept. And then you can speculate on top of that if you want. And those speculative profits should outperform the dividend growth. And it all feeds into the reinvestment stuff. But when you speculate, there are so many different moving pieces, and you don't need to focus on them all. The one thing everyone should focus on is getting out, right? Because the way you get out dictates how long you stay in to the market, right? So if I look at this position here, the volume has died on this position, right? In theory, now I didn't actually watch this in real time, so I placed like a retroactive order for this one on EPOW. in theory, we would have placed one buy here, right, based on that. And then we would have placed another buy of 2 shares. So we would have effectively tripled the position right here. So our average is kind of in the middle where it belongs. Now, my average is here, which means my stop loss for these 2 shares, 2 out of 3, is down here, not down here. And my stop loss for this share is down here. Okay. My take profit for the 2 shares is in between the entry and the take profit for the single share. So I'm letting a smaller piece travel a greater distance and a bigger piece travel a lesser distance. And that's how we make ourselves obey the risk hierarchy. There's a clear set of laws that we can follow to make sure that our losses don't outperform our profits. And the sooner we adopt those, the better off we'll be. Now, adopting them is complicated, and that's where psychology comes in, and that's why I focus on the psychology so freaking much, because I don't care about all the shapes and colors on a screen. That's all great. It just tells you opportunity. It doesn't actually make you money unless you can act on it. So, Breckle's going to adopt you, Porter? Yeah, Breckle. I'm not lifetime, but I'm not going anywhere to deal with it. Okay. I don't want you to go anywhere. I don't want you to go away. I want you going places. And I know you can. I agree with Austin. You're going to be one of those just insane, insane people. I'm going to love it. It's going to be awesome. Once you accept your new life, your future. I'm not even talking about the market. I just mean in general. Once you self-actualize and just crank it up, I think you're going to be a new star in the sky. But I will say also, Breckle, from a cost savings perspective, if you're going to be here more than a couple of years, it kind of makes sense just to do it, just to jump in for the life savings. But that's not my conversation to have with you. It just makes sense financially to me. But, your call. Pookie wants me in lifetime, but that'll be a while. I'll be here anyway. Deal with it. Deathgun, my goal is to help you pay for lifetime with what you learn here. That's it. That's my simple mission. If I can't figure that out, or at least give you the confidence to take that leap, then I have to find a better way. But my goal isn't to get you to pay and join some subscription. It's to get closer access to you. And to get you access to Bull and Lee and all the other resources. Unfortunately, this is a company, and it does cost money to host certain services and provide certain things. And that's not my decision or burden, fortunately. I don't have to, have to carry around the burden of being the business owner. So my job here is to try to provide value in a way that makes sense. So if you're on the free side, you're struggling with certain things like emotions in trading, for example, it wouldn't make sense for me to talk about specific things, because the prerequisite to those certain things would be having the discipline and the self-awareness to not allow the emotions to interfere, right? Because then the risk would be much higher. Like, we can't short naked contracts if we can't control our emotions, because if something blasts and we have to take that hit or we're force liquidated, that's an emotional grenade, right? Plus, that could potentially put you in debt, things like that. So we got to be very careful about what we teach and where. The value you bring on these streams is priceless. So much knowledge. Love it. I'm glad you guys are here. I certainly didn't mean to be streaming from 9:15 in the morning to 1:38 p.m., but I'm glad I was able to. So I'm happy about that. I do need to check, because I might have, I do have to leave here pretty soon. So poor Bull has a spread trading coming up at 3 o'clock Eastern. So I want him to have the floor for that. So with that said, let me put the I'm just gonna put the link there in the chat. You guys don't have to buy anything. I'm just putting it there in case anyone is on the fence. I'll put it on socials as well. That is the link to Premium. If you want to join that, that's where you'll be able to see Bull do his live trading. Lee is going to live stream tomorrow morning at Market Open, as well as Thursday and free. So make sure you guys are there for that as well. Here's the lander for that. If you put your email in that form right there on that page, we'll send you a reminder email with the YouTube link for his stream on Thursday, so that you don't forget and miss it. But I'm still here for a little bit. So thank you, Top, for being here. I appreciate it. I'm glad you guys are here, especially you, Top. You are living testament to to the right mindset. So I love it. Anrad, welcome back. You just finished your health profits for the day. That's beautiful. You're taking care of number one. That's good stuff. Did you have a good workout? Death Gun, no, I know. I just don't believe that I'll be able to trade my way up to it. So let me ask you a question. Do you believe that trading your way up to it is the only way to get there? Because I'm going to put something in front of you real quick. Again. And I want you to tell me if this seems like a reasonable approach. Is this something you believe you could do over time? On a scale of 1 to 10, everybody here, if you don't mind just putting it in the chat, how financially secure are you outside the market? For your own interpretation, your own perception of your financial well-being. Well, thank you, Top. I appreciate that. And yeah, Breckle, hanging out with you is the best. Dude, we got to hang out in person. Here, you are the one person in Trader's Paradise that was exactly the way I expected. Charlie Fergie says 10. JWAG says 7. On-rod sell order filled when he was working out. Good stuff. Little passive profits. Financial security isn't having a job or having enough money. Well, when you get to a certain point, having a job isn't a requirement for having enough money. So for right now, you asking that question in the context of being worried about your financial future and the growth of it means that, yeah, having a job or some form of income. Like, are your bills covered? Do you have room for improvement? And I'm not talking about taking on second jobs and all that good stuff. I'm just talking about, do you have full visibility of your budget? Do you have all your inflow and outflow completely mapped out? You know exactly where your recurring charges are throughout the month. You're only paying for things that you're using. You're not necessarily destroying your quality of life to pay and save money, but you're comfortable and that you're efficient. Are you taking advantage of promotional offers? Are you calling Verizon right now and being like, I use this example a lot. Are you saying, hey, I've been with you guys for a while. I'd love you as a carrier, but I found a better offer somewhere else. Do you have anything that you're offering new subscribers that you could get me in on? Right? Just have the conversation. It costs nothing. To see if you can get on a promo offer. They usually offer like a couple of months or a year sometimes of just a cheaper plan. So why not? It's worth a phone call. Netflix. Open a customer support ticket. Do it to everything. There's no harm in asking. Right? In this economy, people expect it. It doesn't matter if you're not pinching pennies to not want to pay more for something you're going to get anyway. They're asking more so that they can, grow, ideally. And I just don't like Netflix as a company. Offer like promising all these new releases and then hiking up the price and trying to restrict accounts and then releasing like 700 like dialects. That doesn't count as new releases. Those are dubs. So they're deceptive. So I have zero ethical issue in trying to shortchange them on my monthly subscription. I don't need to. I just don't like them as a company. But, it's worth a conversation. So, and you can only really have those conversations if you fully map out your outflow. You have to know who you're paying and what you're paying for. How many gym memberships do you have? How many subscription services do you have? And like mentioned earlier, if you're not sure, you can always use something like Rocket Money. It's a good tool for just mapping out the initial recurring charges, and just feel free to keep it for a couple of months. See how it works for you. You know, if you're better at spreadsheets, build a spreadsheet. Look at your last couple bank statements, and just go through and map it all out. Do you collect child support? Map it out. That's an inflow. Do you get dividends on a regular basis? Are you making withdrawals? Do you have annuity payments or any form of income? Do you have an inheritance? Like, you have to map it all out so you're aware, right? Then you can dig in and optimize the expenses, right? You can't really optimize the inflow too much unless you want to get a second job or ask for a raise and stuff like that. You really want to disrupt the inflow as much as possible. Disrupt the hell out of the outflow, right? Become financially efficient, become financially secure. Are you contributing to a safety blanket? Ideally, like 6 months worth of expenses in a savings or high yield savings account so you can still access it in the case of an emergency, right? And then after that, are you building your credit score? Do you have a low cost or no cost or even profitable way to build your credit just on the side? It's completely separate from the inflow outflow stuff. Do you have that? Do you have that in the works? Do you have a plan to at least start making progress in that stuff? Then are you at a point where you can make consistent contributions to a portfolio? Do you put money in a savings account? Do you put money in a trust or anything like that? Do you contribute anything to savings? Do you make donations so you get the tax credit at the end of the year? I think the limit's $600 for most individuals, $50 a month to donations. That's a $600 tax credit at the end of the year. That deducts, right? We want to deduct the income as much as possible so that we can get in the lowest possible bracket at the end of the year, because that helps you avoid the poor tax. The poor tax that moderate income people face is because they don't know enough about taxes to reduce their burden to get themselves into the lower brackets. So you pay extra just for having extra. And as American as it sounds to want to contribute more, it's unnecessary. And I personally just disagree with what we get. So it's up to you. If that's the battle you want to have, you can. I'm not saying I'm going to argue with it. I get it. But I'm just saying I personally don't like paying more than I have to for the same amount of stuff that I'm already kind of not getting in terms of taxes. So if that's not an area you want to make efficient, you don't have to. But I personally believe there's more value in contributing as much as possible to an account where I control the interest rate, and then I can provide things for myself and for my loved ones much more efficiently, because I will have consistent contributions feeding into a portfolio. Then that portfolio will be allocated heavily into investments, which yield a return on investment, which, trigger back in. So that's revenue stream number 2, compounding that process. Then I have a speculation allocation, which is smaller, but outperforms the dividend income yield to a certain point, which is stream number 3 that feeds into this portfolio. And then I've got all the losses and all the yield max ETFs that I sell, all the capital losses, deducting from the amount of money that I owe taxes on at the end of the year, which allows this to be a stupidly efficient process. It compounds very nicely, and that eventually trickles back out into financial security. And then you have financial freedom, no longer need a job. And you can sit here on YouTube or Discord for 5 hours and teach people. So is that something that requires a bunch of money to do? At least parts of it? I don't. I think it takes an hour, maybe a half hour, and a Google sheet and some bank statements to at least get that budget process started. Maybe some emails, maybe some phone calls to see if you can get it on promotional offers. Check your credit report. Dispute things. It's things that don't make sense, obviously. It's free to take out a credit card. I'm not telling you to do that or not do that, but I'm saying it's free to apply for one. You just take a little credit score hit. Those are all things we can do today for free. It doesn't cost any money. Then once we have a clean map of our finances and we've got a disproportionate inflow to outflow ratio, so we can continue saving and contributing to accounts like ours. And then we can take portions of that, larger portions, and put those into investments, smaller portions into speculation. We can grow the speculation amount as long as we're locked in, right? We can have consistent discipline. Even if it's just a matter of setting, if you wanted to, just to be a little goofball, you could find high liquidity trades and set a 1 limit, a 1 cent stop loss, 2 cent take profit on everything you trade, and just become a little high frequency trader goblin if you want it. Just collect the data, see what works, see what doesn't work. If you want to just trade displacements and consolidation breaks, do it, collect the data. But there's no point in risking real money until you know something works, right? I wouldn't go to a bank and deposit my money and say, well, they might charge me money instead of giving me interest like this other bank. So here you go, here's $50,000. It wouldn't make any sense. I want to know that bank's going to pay me. Does that make sense? So you get a few grand in debt before loans. Okay, so let's talk about that debt really quick because I do got to jump off here in about 10 minutes. What kind of debt is it, if you don't mind? If you don't want to share it, that's okay too. Is it personal loans? Is it, you said before loans, so I'm assuming that it's probably an obligation that you owe to someone personally. Are there terms to it? Do you owe Big Worm? Are you messing with his emotions? Most importantly, I'm more interested in figuring out, do you owe interest on that loan or on that debt? Or is it a blood debt like John Wick? Like, did you save someone's dog? I'm misinterpreting the plot of John Wick. Oh, take care, J-Bag. Sorry about that. I just saw your message. Oh yeah, Tammy, I hate that when the dubbings are off. Was that? There's a show 1677. It's a lot like Norseman, but I can't get into it. I don't know what it is. It's just, I like Norseman a lot. I just can't I can't stand that one. I don't know. Maybe it's just too dry, but the dubbing is terrible. All right, so look at EPOW. Right? It hasn't really broken out of this range very much, but you know, there's a couple key elements here, and this is what makes us disciplined traders. The fact of the matter is we bought here, right? Now we've got this plan to have bought 1 share here and 2 shares here. So again, I retroactively placed a 3 share buy just to kind of summarize it and put it in the same average. My stop loss for these 2 shares is below this this 1 buy. And my stop loss for this 1 share buy is down here below the range, right? My take profit for the 2 shares is here. My take profit for the single share is here. So none of those levels have been hit yet other than the buy ones. So what is Pookie not going to do? Oh, take care, Breckle. Thanks for hanging out, buddy. I appreciate it. The one thing Pookie's not going to do is just get impatient and start selling stuff. I could sell for a little 1.5% profit right now. It was up, I think, 3% or something at some point. But how often is that going to work against me versus in my favor? If I bought with a justification that these guys are trading a zone recovery range, and I still see remnants of that on the order book, you know, I have a thesis and it hasn't invalidated yet. If it does, I have my sell order right here for these 2 shares. And I've got a clean plan. So why would I anticipate? And why would I take action early just because something's still in this box of inaction? Because I don't do stuff. I don't do stuff until these levels are broken. Let me just going to erase this and draw a line right there where it is. Same here. I'm just going to draw a line right where that was. And I'm just going to draw a line right there for the 2. Okay. So I've got my my sell order here for 2 shares. It's going to be just below this. And then my single share stop loss will be down here. So if it wants to come down, that's okay. I have my control hotkey set up. I can set an order ahead of time and leave it. Charlie, that's a good question. So with SPX coming up now, the PNL is still negative. I have no feelings. I just want to understand why. So the reason for that is because we're trading options. This adds a layer of abstraction. And the reason you're negative is because of what the contract represents, okay? It represents the right, but not the obligation to buy or sell something that the contract represents. So the value of that contract, which is the value of the right to buy or sell, is going to be different based on how likely that contract is to be worthwhile at the time they want to do it. So right now, you've bought the right to buy, in theory, we'll just call them shares. It's not actually what happens with SPX, but let's say it was SPY, right? You would have bought a contract that represents the right to buy 100 shares on or before a certain date and time at a specific price, right? So that's going to have a certain value when you buy it because there's still some time left on it. There's still some price range. There's going to be some distance that it can go, right? When time narrows, when you have less time left, the value range of that contract is going to shrink because there's less time for it to hit that target. Does that make sense? And the analogy I like to use for this is that if you imagine a park, okay, and you want to have a food stand at a park Monday through Friday, you need to go get a permit, okay? That space is yours. You can do whatever you want in the park, even if you just want to stay home and watch TV on Monday and Tuesday. On Wednesday, Thursday, and Friday, though, that permit, if you wanted to sell it to the next person, is going to be worth less because they're not going to pay you for the full 5 days. They're only getting 3 days. You know what I mean? And options contracts work the same way. So over time, they decay in value because there's less likelihood that it'll hit the target and there's less speculative room for the value of that contract. So that's why you're seeing a negative P&L despite the price pushing up. And that's why you can be absolutely right on SPY and SPX and Tesla and all those 0-day contracts, even long-term contracts. You can still be right. But if you're not right, in addition to having a certain rate of growth or rate of movement to outperform the time decay and the IV fall off on that contract, you're not going to make a profit on it. So you can be right and wrong at the same time. So that's why with options contracts, you always want a time cutoff, you want a percentage cutoff, and you want a price action cutoff. So we always have to have those 3 exit conditions. So like for SPX, I like using 30% when I intend to cut it. This one, I'm okay to let it go to a loss because I can use it for taxes. So I don't really care. If I didn't want to take it for a bigger loss, I would have cut it at 30%. Or if the price invalidated my setup, which it didn't, because remember my cutoff for that would have been down here, right? But we didn't get that. And the time cutoff would be a rate of beta. So typically about an hour or so for SPX. It depends on where it moves within that. So hopefully that makes sense. Let me, I'm going to end the live stream here, though. I'll hang out with you guys in Discord for another couple minutes, but thank you all for watching on socials.